and assurance. So we are starting our special intervention class today for advanced audit and assurance. And I welcome you all to the very first day of the class, of the special revision class. So for the 2 days, today and Sunday, 1 p.m. to 5 p.m., we will be revising what you are supposed to know before you sit for the exam come July 2024. That's just next month. I think that paper is on 2nd July. Afternoon session 2. What's the time? Is it 2 to 5? So first we are starting with, let's see I have the brief introduction about what you are supposed to know before you sit for the exam. So the examination structure, the overview, what you are supposed to know. So the structure of the examination. Your question 1 will always be on issues around professional and other considerations. Your question 1 will always be on issues around professional and other considerations. That will be for 20 marks. Then your question 2 and question 3. Your question 2 and question 3 will be on audit of historical financial statement. That will be for 50 marks, your question 2 and your question 3. On audit of historical financial statement. So it means that part of the question 2 and the part of audit of historical financial statement, you may see it in question 5. You may see it in question 5. So part of this, you may see it in question 5. Or sometimes the examiner can decide to give the other 10 marks for question 5 to audit of historical financial statement. Your question 5 is on current development, current issues in the auditing space. What are the new things that the International Accounting Standard Board, what they are trying to do? So this area, I told you earlier, this one we don't teach in class. The current development, we don't teach them in class. So as a final level student of ICAG, you are supposed to be abreast with any current development going on. So this one, and mostly if you won't see question on current development, then 10 marks will be from professional and other considerations. Then the other 10 marks will be on audit of historical financial statement. Then question 4. Question 4 is public sector auditing. Question 4 will always be public sector auditing. Question 4 will always be public sector auditing. So this is the examination structure. This is the way your examination questions will be like. Now, I have a breakdown of what you are supposed to know under each of the topics, under each of the headings, what you are supposed to know. So when you come to the first one, which is the professional and other considerations, there are 4 topics you are supposed to know there. So under professional and other considerations, the first topic is the regulatory environment. Then you talk about rules of professional conduct. You move to professional responsibilities and liabilities. Then the 4th one is on the practice management. So under the regulatory environment, you are supposed to know how auditors are appointed, who qualifies to be an auditor, resignation of auditor, removal of auditor, You are supposed to know issues surrounding money laundering, compliance with laws and regulations. This one talk about the standard is ISA 250. The issues surrounding corporate governance, especially audit committee, AC. We see audit committee, the normal auditing word is those charged with governance. Those charged with governance. So under the rules of professional conduct, you are looking at the ethical principles. So you are looking at the ethical principles. We are talking about the issues surrounding threat to the ethical principles, how the threat can be mitigated to an acceptable level, the issues around the conflict of interest, confidentiality, then corporate finance advice, auditors acting as auditors giving financial advice to their client. There are some rules governing auditors on giving finance advice to their clients. Then you discuss professional responsibilities and liabilities. So issues surrounding liabilities of auditors. Issues about fraud. We know that fraud is criminal. Fraud is criminal and is intentional. Then error is what? It's unintentional. So error is civil. Error is civil. Then we talk about issues concerning responsibilities of management and responsibilities of audit. And we all know that it is responsibility of management to what? What are the responsibilities of management? Responsibilities of management. The responsibilities of auditors. Management, they are supposed to what? Prepare financial statements in compliance with applicable financial reporting standards. The auditors, it is their responsibility to do what? To perform procedures, to express an opinion on the true and fairness of the financial statement. Management also have the responsibility to do what? To institute internal controls, to determine risk that affects the organization from achieving its objectives. And management have the responsibility to make sure that what? The controls are effective, the controls are functioning to what? To mitigate against the possible risk that could affect the organization. Now, when it comes to controls, I gave you some abbreviation that in exam, anytime you see recommend controls, what is the abbreviation? In a question, when they say you should recommend controls, what is the abbreviation you have to use?
SPAN.
So SPAN. So S-O A P
E SPAM.
SPAM. So anytime you see recommend controls, remember the abbreviation, so SPAN. So the S stands for what? The S stands for what?
Segregation.
Segregation of duty. The O stands for what? Organizational control.
Organization.
Then the A stands for
authorization.
Authorization. The P.
Is it the physical control?
Yeah, the P's are two. So one is personnel training and the other one is physical control.
Yeah.
Okay, so kindly take notes of that. Then under the practice management, we discuss issues concerning how does auditors obtain professional appointments. How do the auditors gain professional appointments? Do they advertise? This one is revisional, so you have to be fast. How do the auditors gain professional appointments? Are they allowed to do the advertisement? Who is talking? So they gain a professional appointment through what we call tentry. Something is in the chat box. Actually, say yes, they're allowed to do advertisement. They're allowed to do advertisements. Agnes, kindly unmute and talk to me.
Hello.
Yes, we can hear you.
Yes, I'm by the roadside to pick a car. That's why. Yeah, so I was saying they can advertise.
Auditors, they're allowed to do advertisement.
The auditing firms,
The
yes.
auditing firm, yes.
Yeah.
Okay, but there are some requirements that they have to meet. Is that not it?
Yes.
And the requirements will not even permit them to do advertisements at the first place. They can advertise, but the requirement to do advertisement will even throw them out of, or not to even do advertisement. So the main approach they use to gain an appointment is what we call the tendering. Then agreeing the terms of. So let me go back. Last date. Question 1. Last date. Question 1 is about what? Question 1, last date. I think rules of professional conduct came. Ethical principles and the threat to the ethical principles. Is that right? So I believe question came on the ethical principles. Then agreeing the terms of audit engagement. I think this one too also came. Agreeing the terms. What audit firm you are supposed to do before you accept an engagement. And then that's the engagement letter. The quality control. Quality control measures. The change in professional appointment. What will necessitate a change in appointment of an audit firm? So that's your question 1. So question 1 will be on this area. So last date, the question came from the ethical principles. I think that question was 10 marks. The question came on the other part was on agreeing the terms of audit engagement. So they gave you some questions. Auntie Rhoda, kindly mute for us. Thank you very much. So the 2 questions that came, the A and B for last date, A is on the ethical principles. Then the B part was on the acceptance of an engagement letter. So this date, you don't know where the question will come from. So you are supposed to be conversant with issues on professional and other considerations. Then your question 2 and 3, which will be on audit of historical financial statement. So under the audit of historical financial statement, we discuss issues on planning. So under planning, what do you do under planning? What do you do under planning? Let's be fast.
You try to know your clients, you obtain understanding about your client operation.
Okay.
Plan the reality risk assessment. Materiality, the risk assessment.
Okay.
And you look at the applicable financial framework that the organization is in.
Okay. So under the planning, we obtain knowledge. Under the planning, you obtain knowledge. Then you do what? You do risk. You do risk assessment. The risk assessment, then you select your audit strategy. Audit strategy. The audit strategy can be the audit approach.
You will not mention materiality.
Yes, I'll get there. Then you do materiality. What do you do again under the planning?
Audit plan.
Audit plan, audit plan. Your audit plan. Okay. So all these things we discuss them into detail. So today, you're just coming to revise. Look at some likely examinable questions, then we move forward. Audit plan, okay. Now, then after you plan your audit, then you execute. So under the execution, you what? You perform what?
Procedures.
You perform procedures. You perform procedures. And the procedures are the what? Are the audit what? Approach. You perform procedures, the approach you are going to use. You perform procedures. Good. Then you perform procedures and do what? And procedures are this is what? This is the action. The action word. So you examine that, examine this document, review this document, check this document. You do analytical review. Then how you perform procedure, what do you do? You obtain what? Evidence.
Sufficient and appropriate.
Yes. Sufficient and appropriate what? Audit evidence. That will determine the kind of opinion that you express on the financial statement. All right. The review of the working papers. You do review. After you perform procedure, you do review before you report. So under the review, what are the things that you are supposed to do?
Be to evaluate the financial statements. Then check for power period.
Okay, so you do opening. You do opening balance. You check the opening balances. Somebody is giving me feedback. Or maybe the person is using two devices. All right. You check the opening balances and see that all opening balances have been brought forward correctly. You check the arithmetical accuracy, you check the consistency of the accounting standards that have been used. Then you do what you call MARA. What the full meaning of MARA?
Reality.
Is the materiality.
Yeah.
You check the M is the materiality. Then A is what?
The accounting standards or the applicable financial framework.
So A is the accounting issues. What will be the treatment of the items? Then the R is what?
Risk assessment.
Risk assessment. The E is what?
Evidence.
The
obtained.
evidence that you have obtained. Evidence is obtained. Okay, let's go on. Then after that, then you report on the true and fairness of the financial statements. And the reporting, what are the types of opinions that you can express on the financial statement based on the evidences that you have gathered?
Be a qualified or...
So you can issue qualified opinion. Now, the qualified opinion, how many types do you have?
We have 3.
We have 3.
Yeah.
Okay, so
We
you
have-
can issue. Mr. Robert Gogo, I think your device is giving me feedback. All right, let's move on. So qualified opinion, can issue qualified opinion what? Except for. So you can issue except for. What will cause the auditor to issue a qualified opinion except for?
When it is material but not pervasive.
Okay, so the issue is material, but it's not pervasive. So the opinion will be qualified opinion except for. All right. Then you can issue which one again? Adverse. Adverse opinion.
And you can issue adverse.
Okay. So the adverse opinion, when the issue is material and it's what?
Pervasive.
And it's pervasive. All right. Then you can issue, the third one is what?
Disclaimer.
Disclaimer. You can issue disclaimer of opinion. Okay. Now, under the qualified opinion,
Disclaimer.
there is one thing that we didn't discuss. There can be what? Limitation is what?
The scope.
Okay. Limitation in scope. All right. So if the limitation is material but not pervasive, then you should qualify opinion except for. But if the limitation is material and pervasive, then you issue disclaimer of opinion. All right.
Disclaimer.
Okay.
Yeah.
Let's move on. The audit report, the structure of the audit report. The structure of the audit report. Structure of audit report. Forget about the introductory part. That one, the examiner is not interested in the introductory part. So the first main thing you see is what? Is the opinion. Is that not it? So you should forget about the introductory part, the name and the name of the address of the to the shareholders. Forget about that one. So the first thing you will see is the first important thing you see in the report is the opinion. So the opinion can be any of the opinion that we have discussed above. It can be qualified opinion except for, it can be disclaimer of opinion. It can be what? Adverse opinion, and it can be what? And it can be what? Qualified what? Opinion. All right. There you will see what follows the audit, the opinion paragraph.
Basis of opinion.
Basis of
You have
opinion.
Basis. Is it for or of?
Basis of.
Is it of or for?
Basis of opinion.
Basis for opinion.
Is it of or for?
For.
All right. So basis for opinion. All right. Basis for opinion. So which important paragraph will follow the basis for opinion paragraph?
Emphasis of matter paragraph.
Emphasis of matter. And what goes into the emphasis of matter paragraph? What will cause the auditor to include the emphasis of matter paragraph in the audit report? We are revising these things, we know them, so let's be fast.
So feature uncertainties.
If you say feature
Mitigation.
uncertainties, I don't get it. Kindly break it down for me. My English is not that good, so if you use big grammar, it will worry me, my boss. Future uncertainties like
Is it the adaptation of new IFRS?
adoption of new international financial reporting standards. Yes, but what to make the auditor to include it in the emphasis of the matter paragraph?
So you were saying the future uncertainties like major catastrophes.
Major catastrophes, okay. Major catastrophes, all right. But before the issue can be what? Can be included in the emphasis of the matter paragraph. Something must be done before the auditor can use that paragraph, can use the emphasis of the matter paragraph. That's what I'm asking for.
When it casts significant doubt to the going concern of the entity.
The going concern, then it will not be under emphasis of the matter. There is another paragraph for going concern, material uncertainty relating to going concern. That one,
Uncertainty.
that means when the issue casts, or when the issue casts doubt on the going concern assumption of the entity, then you will not include emphasis of the matter paragraph. It will be material uncertainty relating to going concern. That paragraph is different from
Related, yeah.
the emphasis of the matter paragraph.
From this one.
Yes. You see, under the emphasis of the matter paragraph, first of all, the issue must be included in the financial statement. The issue must be reported by management in the financial statement. That the auditor think that that issue will affect the decisions that users will place on the financial statement. So the standard requires that the auditor have to draw the attention of the users to that issue in the financial statement. Example is the adoption of new international financial reporting standards. The standard must be included in the financial statement. Then the auditor, you draw attention of the users to it. So you refer the user to the note in the financial statement that's talk about the issue. Is that okay? So if the issue is not included in the financial statement, it cannot come under emphasis of the matter paragraph. No. Kindly take note. So the auditor have to draw the attention of the users to the issue disclosed in the financial statement. The issues that the auditor think they will influence the decisions of the users. All right. Followed by the emphasis of the matter paragraph is what? Key audit.
Audit matters.
This one, if applicable. And which entities are required to have the key audit matters? You know, it's not applicable to all entities, no.
Public deposit taking institution, like bank, financial institutions.
Listed firms.
I can't, who is talking? I cannot hear what. Public what? Who is talking?
So
listed firms.
Okay, listed entities. Entities that are listed on the Ghana Stock Exchange. And public what? PI what?
PIEs.
PIE. What's the full meaning? What's the full meaning?
Public interest entities.
Public interest entities. All right, like the banks, the financial institutions. All right. Then we have the other matter paragraph. Other matter paragraph. This one to if applicable. Now, what to cause the auditor to include the other matter paragraph in the audit report?
When there's a limitation of scope imposed by management.
All right. I think the standard listed 3 of the issues. Are they 3 or 4?
There are 3.
All right. So when there's a limitation on scope, issues limitation on scope. The areas that requires what significant what auditor's judgment. Is that not it?
Yes, that's the local laws that allow the auditor to elaborate more on his responsibility.
Okay. All right. I beg you.
When the previous auditor did not audit the financial statement.
All right, fine. Okay. Now, all these issues, what we are just mentioning, when the auditor, the current auditor is not the one who audited the entity previously, when local laws allow the auditor to elaborate more on his responsibilities when there are limitations on scope. Mind you, these issues will not be what? They will not be included in the financial statement. Is that not it?
Yes.
So they will not be disclosed. These issues will not be disclosed in the financial statement. And the auditor wants to draw the attention of users to these issues because they may influence their decisions. So that's the difference between the emphasis of the matter paragraph and other matter paragraph. The emphasis of the matter paragraph, the issues will be disclosed in the financial statement. But if you come under other matter paragraph, the issues will not be disclosed in the financial statement. All right. So, yes.
The limitation on scope.
Yes.
Which is supposed to come, or if applicable, come under the other matter paragraph.
Yes.
We also know that our basis for opinion considers limitation on scope.
Yes.
I want to ask that if the basis of our opinion is in respect to limitation on scope, are we still going to bring it under the other matter paragraph?
No. You do, then that one you bring it on the basis for the opinion. So you don't bring it at the other matter paragraph again. No.
So which level of limitation on scope will be brought here? Is it the one that is not material and neither pervasive?
Yes. No. If the limitation of scope, if it is material but not pervasive, that one to you issue qualified except for. But you see, some limitations can be in such a way that you will not have full access to the information. Are you getting me? You will not have full access to the information. So this one, under the other matter paragraph, even the limitation of scope will influence your opinion that you express on the financial statement.
That is my point.
It will influence your opinion that you express on the financial statement. So this one, under the other matter paragraph, I don't think limitation of scope will come here. No. I don't think limitation of scope will come here. No. Because limitation of scope will influence the opinions you express on the financial statement. So other matter paragraph, you cannot bring it here again. That means you are repeating it twice in the financial statement.
So that is my concern.
Your audit report. Thank you very much.
But it's part of.
Limitation is part.
Yes.
Limitation is part, even though if it is include and under the opinion and basis for the opinion paragraph. Can we get that? Let me look for that note. Let's be clear. Let me look for that note. Give me a few minutes. I think that's, and it will be under audit reporting, right? Audit.
It says that possible effects of a limitation of scope imposed by management.
Okay. Yeah, so possible effects.
A limitation of scope imposed by management.
All right, let me go there and see.
All right.
So we have key audit matters, material and setting relating to going concern. Yes, it's here. I hope you can see it. Possible effects. Okay, circumstances for using other matter paragraph. Okay, possible effect on limitation of scope. All right. So it's there, possible effect. So this one, you see, what it means is that even though it will make you to express, it will have effect on the auditor's opinion, if the limitation will have any effect on the auditor, on the user's decision that they will place on the financial statement, you still have to bring it down here. So this one is based on the auditor's judgment. It's based on the auditor's judgment. It's based on the auditor's judgment. So if the auditor will think that even though the limitation has made you to what? To issue qualified opinion except for, or to issue a disclaimer of opinion, if you think that the limitation can have effect on the user's what reliance that they will place on the financial statement, then you still have to bring it under the other matter paragraph. You still have to bring it under the other matter paragraph. Okay. So that will be your question 2 and question 3. So question 4 is your public sector audits, where you can pass your exam. Very, very simple. So under the public sector audit, you do the performance audit, compliance, and financial audit. Then I've been saying it. Kindly know duties and responsibilities of the following bodies. Very, very important. Kindly know duties and responsibilities of the following institutions. It's very, very important. Very, very important. Now, under the performance audit, what do you do under the performance audit? What are the principles of performance audit? I think this one came in the last diet. Is that not it? Last diet. The question that came under on the public sector auditing. Is it not on the performance audit? Can somebody hear me? Oh, my mic is off. Oh, my mic is
Yes,
Mic is on. It's on.
off. Right.
we can hear you.
The last diet question is not on the performance audit. And what are the principles of the performance audit?
We have the
It's
economy.
about efficiency, effectiveness, and
Economy.
Okay. We have the three E's.
Yeah.
The 3 E's. So compliance audit, you are doing compliance with what? Laws and regulations.
regulations.
Okay. The financial audit is still the same as the financial audit in the what? In the private sector. So you are checking that the financial statement is prepared in compliance with what? Public sector, what is the standard? Public sector, they use international financial reporting standards.
Yeah, IPSAS.
They are using IPSAS. IPSAS, International what? Public Sector Accounting Standards.
Yeah.
All right. Good. Then the last thing is the other assurance services. The other assurance services. The other assurance services. So you do due diligence audit. Why do you conduct due diligence audit?
When there is a takeover.
Okay. In mergers.
Mergers, yeah.
And acquisition. Okay. So you do the due diligence audits in time when a company wants to merge, when a company wants to acquire another company. The forensic audit is done when? When do you do forensic audit? When there is issue of what? Of fraud. And the case is in court. So you perform forensic investigation to disprove or prove what? An investigation. Then you do the interim audit, interim financial audit. This one too, always or mostly applicable to what? To listed entities. Applicable to listed entities. Then prospective financial information. Future what? Estimate. Future estimate. Example is profit forecast. Profit forecast. Or cash flows. So the auditor, your client will what? will contact you to perform audit on their profit forecast or their cash flow. Okay. The social and environmental audit, the review of performance information. So these are the things you need to know before you take your exam in the advanced audit and assurance. So let's start with the likely of the possible examination questions. Today, who will read for us today? Who will read for us? Auntie Agnes. Is Auntie Agnes here? Okay, she said she's on the way going home. All right, so who will read for us? Auntie Agnes is now on the way going home. So let somebody kindly read for us. Let's start.
I'm reading.
All right, Sister Doris.
Question 1.
But first of all,
You are an
I always tell you, first read the requirements of the question. Read the requirements of the question before you start reading the paragraph. So read the requirements for us.
required. I critically evaluate any possible ethical issues arising from the client's request. That's 4 marks.
Okay.
I discuss whether the auditors may be liable to the bank in case the audit was negligently done.
So the first requirement, you are to what? Evaluate any possible ethical issues. Then the second one, you are to discuss whether the auditors may be what? May be liable to the bank in case the audit was negligently done. All right. So let's go to the paragraph. Let's see what is contained in the paragraph. Auntie Doris, you can start reading.
Okay. Question 1. You are an audit manager with AA & Co, chartered accountants and business consultants. You have been assigned to the audit of Western Decos Limited, a long-established firm of event planning service in the city where your practice is located. The audit of the financial statement for the year ended 31st March 2019 is due to commence shortly. The audit firm is aware that the client has received a loan from the bank in April 2018 and that the bank will rely on the audited financial statement as part of the terms and conditions in the loan agreement. The partner in charge of AA & Co has just visited the client and made the following notes during his trip.
Sister Doris, what I normally do is we'll be discussing the question. So we'll be identifying the key issues in each of the paragraph before we start answering the question. So the paragraph 1, they say what? The audit of the financial statement for the year ended 31st. So the financial year ends 31st March 2019. Is due to commence shortly. Okay. The audit firm is aware that the client has received a loan. The client has received a loan from the bank in April 2018, and the bank will rely on the audited financial statements as part of the terms and conditions in the loan agreement. All right, so let's go on. So the auditors are what? AA. The auditors are AA and co-chartered accountants. And the firm is what? Western Decos Limited. Okay, let's move on.
Okay. The firm has a number of individual and corporate clients outside Accra and has invested heavily in recording and broadcasting event equipment to allow some events to be broadcasted over the internet. This facility is now available at all events conducted in WD's premises and is proving to be very popular. To date, no specific extra charge has been levied for this service, but the CEO of WD The CEO of WD has asked us to prepare a report for him advising on whether it would be practical to charge separately for it, and if so, the level at which the charge should be set. Please, should I read the next one?
Yes, read the next paragraph.
Okay. Unfortunately, WD's main supplier of chairs went into liquidation during the year. The partner said that they were fortunate to be able to find an alternative supplier with whom they entered into a 3-year contract for the supply of chairs. At the time of signing the contract, WD considered the contract to be on a very favorable terms. However, the supplier is based in Nigeria and the contract was dominated in Naira. Movements in the exchange rates now make the contract look far less attractive, and the CEO has requested that we examine the contract to see if there is any way he can legally set it aside.
Okay. So we are to evaluate any possible ethical issues arising from the client's request. Now, what is the request of WD Limited? What is their request? What are they requesting the auditors to do, the partners, the AA and co-chartered accountant? What is the client requesting them to do?
So please, to audit the financial statement of the company.
Okay.
Assurance engagement.
What engagement?
Assurance.
All right. So you see, they are to perform an assurance engagement, and the CEO of the company is asking the auditors to prepare a report for him, advising on whether it will be practical to charge separately for it. Now, what is he charging for it? Is it starting from the paragraph 2, the firm has a number of individuals and corporate clients outside Accra and has invested heavily in recording and broadcasting equipment to allow some events to be broadcasted over the internet. So this facility is now available at all events conducted in WD's premises and is proving to be very popular. So to date, no specific extra charge has been levied for these services, but the CEO of WD has asked us to prepare a report for him, advising on whether it would be practicable to charge separately for the services. So there are services of what? Broadcasting of recording and broadcasting the events of their clients over the internet. They don't charge separately for it. So now the CEO is now contemplating whether if they should be charging separately from they have individual clients and corporate clients. So what they normally do now is they charge both the individual and the companies the same price. So now the CEO is now asking whether if it will be practicable for the auditors to prepare a report and advising whether if it will be practicable for him to charge separate fees for both individuals and the corporate. And if so, if it will be practicable, the level at which the charge should be set. So the auditors should prepare their report determining whether the company, the WD, can charge separately for both individuals and companies. And if it is practicable, what is the fee that he should charge, or what is the applicable fee that should be charged? Now, the third paragraph is saying that, unfortunately, WD's main suppliers of chair went into liquidation. So their main supplier is having what? Liquidation problems. during the year. So that supplier said that they were fortunate to be able to find an alternative supplier with whom they entered into a 3-year contract for supply of chairs. So their main supplier went into liquidation, but they are able to get an alternative supplier. WD is able to get an alternative supplier whom they have entered into a 3-year contract with. Now, at the time of signing the contract, WD considered the contract to be what? To be very what? Or to be on favorable terms. However, the supplier is based in what? In Nigeria. And the contract was dominated in what? In Naira. It's another area, one key area to what? To take note of. Their main supplier went into liquidation, and they were able to get another supplier of chairs because they are into event planning. Now, the new supplier they have now, the supplier is not based in Ghana. The supplier is based in Nigeria, and the contract was denominated in Naira terms. What will affect them over here? What is the issue that you have to consider here?
Is there foreign exchange loss?
Yes, definitely there may be foreign exchange loss here. There may be foreign exchange issues because they have to convert the Naira to what? To Ghana cedis before they can report on it in their financial statement. So it's very likely that there may be a foreign exchange loss. All right. Movement in the, it's even stated here, movement in the exchange rate now make the contract look what? Far less attractive. You see, movement in the exchange rate now make the contract look what? Far less attractive. And the CEO has requested that the client, the auditor, examine the contract to see if there is a way he can what? Legally set it aside. So the requests are two. The requests are two. The first request is the request by the CEO of WD is the client, the auditor, the audit firm to prepare a report to him on whether he can charge a separate fee for both individuals and the corporate. And if it is possible, at what level? You're asking the auditor to prepare a report to you, giving you the level at which you can set your charge. You say what?
Given the level you can charge your own
prices. Definitely there'll be ethical issues there.
Yeah, it's like the auditor being playing the role of management.
Exactly. So there may be management threats over here. Is that not it?
Yeah.
So they say you should identify possible ethical issues. So that is one. There may be management threats over here, management issues. The auditor assuming the responsibilities of management, because you're asking the auditor to ask you to prepare a report to you and giving you the level at which you can set your own price. So there may be ethical issue there. There may be management threats over there. Then the second one, the second request is to what? Now you've entered into a contract with a foreign-based company in Nigeria. And even when you are setting or the terms of the contract, everything was dominated in the foreign currency. And at the time of signing the contract, the exchange rate is now what? It's now look far less attractive. Because of that, the CEO, you are now asking the auditor to examine the contract to see if there is any way you can legally set the contract. You can terminate the contract. You have already signed the contract. You signed the contract without considering all those things. Now you're asking the auditors to perform their work and advise you on if there's any way you can terminate the contract, because you now see that the exchange rate is far less attractive and there will be foreign exchange loss. So what are the ethical issues? Let's identify the first ones. We've identified one already, which is management threat. What will be the second ethical issues?
So the self-review can come in.
Self what?
Self-review.
All right. So if you identify, you must be able to explain, my boss. So what to bring the self-review?
Like you said, the management acting as a management position. So in the event that you have given all this information to management you will come back to come and audit those information again.
Thank you, senior. Self-review, self-review. I'll be saying it. This is the default. When you are handicapped in auditing exam, self-review, write that one first. Definitely in every ethical issues in auditing, advanced auditing, the self-review is the default. So write that one. When you are handicapped, you don't know what to write. Write the self-review trait and try to justify it like what our brother just did. You will get your mark. So we have two. The third one will be what? At this stage, I cannot be identifying the issues for you. You must try your best to identify them. So we have two. We have the management trait. Then we have the self-review. At least we should be able to identify four. To get your 4 marks, you should be able to identify 4. Let's be fast, and we don't have much time on our side.
So they say the partner said that they were fortunate to be able to find an alternative supplier with whom they entered into a 3-year contract for the supply of chairs.
Okay.
So in this scenario, is the partner trying to be an advocate for the client, or I don't know.
Who is the partner?
Is the partner not from the audit firm? The partner is the assurance client.
The assurance client. Okay.
And he is of the view that they were able to assign to. They have been able to assign to the. I was reading some particular paragraph.
Yeah, it's down here. It's not here you're talking about. You are reading from.
The partner said that.
It's not here.
The partner said yes.
It's not here you are reading from.
I don't know whether there's a threat over there. The partner said they were able.
Who do you think will be the partner here?
That's the auditing firm, because if you scroll up a little, it said that the partner visited them. Partner of AA.
Where is that?
Oh, up.
It's if I scroll up little.
Please. It said the partner in charge of AA and Co. has just visited the clients and made the following note during his trip. So it's the partner that is making that advocacy. So in line with what my brother is saying, there's an advocacy threat.
Okay.
So why should a partner be having such form of advocacy? The partner said that they were fortunate to be able to find an alternative supplier with whom they entered a 3-year contract for the supply of chairs.
Okay. So it means that is the audit firm, the audit partner.
Yeah.
Who has identified the alternative supplier.
Yeah.
So there will be what threat over there? There will be what threat?
Advocacy.
There will be advocacy. There will be advocacy threat here. All right. What about the place that the CEO has requested that they re-examine the contract and see whether if there's any way he can terminate the contract? Would there be any threat over here? You see, it's like the CEO is directing what the audit firm on what to do. So there's no independence over here.
So it can be intimidation.
Yes, it can be a form of intimidation. But the independency of the auditors too is not assured. Like the CEO is the one directing them on what to do. the CEO that is giving them instruction on what to do. Allow the people to do their work and report to you on their findings. Even this paragraph here, this one too. They say you should prepare the report for him on whether it will be practicable to charge separate fees. And if so, the level at which they should charge. It's like giving them their audit objectives on what to do. So allow the people to set their objectives and perform their audit and report to you. Now, let's go to the second requirement. You are to discuss whether the auditors may be liable to the bank in case the audit was negligently done. Would they be liable to the bank? From the very first paragraph, we were told that, where is that? The audit firm is aware from this paragraph. The audit firm is aware that the client is the WD, has received a loan from the bank in April 2018, and that the bank will rely heavily, on the audited financial statement as part of their conditions in the loan agreement. Now they're asking you, they're asking you to discuss whether the auditors may be liable to the bank in case they have done the work negligently. Would they be liable to the bank?
Yes.
Yes.
Okay, so you have to explain.
So they will be liable to the bank because it is based on the audited financial statement. That is what the bank would rely on to give a working capital to WD, which is their client, for them work, because one of their suppliers, they have even gone into liquidation. So what it means is that there is there's a certain risk factor around the operations of the business. So the bank would want to rely on the audited financial statement so that they can be safe in other ways where they can mitigate their risks. And based on that, then they can advance whatever facility that they want to give. Be as it may, if the bank or if the auditor becomes liable, then the bank, they can use the law of tort, because then the duty of care that we invoke.
Mr. Nathaniel, we cannot hear you again.
Hey, once I've been talking to myself. Hey. So, please, can you hear me?
Yes, we can hear you.
Okay. Now. All right. Yeah. So, I was saying that.
All that you have said, we've heard it. It's the ending part that we didn't hear.
Okay. Yeah. I was saying that, be as it may, if the auditor, if they are liable, then it means that then the bank can exercise the law of tort, because the duty of care, which is to be given to the bank, is broken.
All right. So in that case, how does the third party establish? There are three requirements that the standard says that the third party you must meet before the court can listen to your plea. So first one, that is it. You must establish that the duty of care has broken. And what's the second one? And the third one?
There should be.
Auntie, Sister Patience, kindly unmute for us. Kindly mute your mic for us. Sister Patience. All right, thank you very much. Sister Jennifer, you were talking.
Exactly. So I was saying that one, there should be a contract. Two, there should be negligence, and three, the liability should be because of the financial statements.
Okay.
Like the liability should be because of the information used by the third party based on the financial financial statement. So it might have caused a financial loss to them.
Oh, all right. So thank you very much. So you must establish that there's a country. There's a duty of care. So the first one, you must establish that there is duty of care. Then the second one, you must be able to establish that the duty of care has been what? Is broken. Okay. Then
the loss of the damage.
Then you must establish that you suffer what? Financial what? You
Loss.
suffer a financial loss. So in this case, okay, let somebody add again, then maybe I'll conclude. Our brother Nathaniel just elaborated what exactly you are supposed to write in the exam. It's 6 marks, so you cannot write 2 paragraphs and let's say 2 lines and get your 6 marks. No. So let somebody add, then maybe I'll conclude.
Hello.
Yes, Sister Angela.
Please, can you say that reliable because management made the auditors aware that the bank is going to be relying on their audited financial statements?
Yes, you can say that, but just that you cannot end there.
Oh, okay.
You can say that. That was just like 1 paragraph or one sentence. Is that not it? That one, maybe it may fetch you maybe just 1 mark. In auditing exam, I'll be telling you the marks to guide you on how to write. And when you are writing, don't write the thing in paragraph plenty. No, try and bullet it. Bullet it like a point. If you are writing plenty paragraph, it will be difficult for the examiners to mark. So try and bullet the thing like a point.
Sir.
Yeah, somebody is saying, sir, yes.
Can you link it with confidentiality that the auditor ought to, by law, disclose that information to the bank? That, as you know, when it comes to confidentiality, consent of the client must be sought, and then by law, the auditor must be able to come out with such information. So, can you relate it to that the auditor ought to disclose this information according to the law that regulate their operations?
So disclose the information to who? Let me ask that question first.
To the bank.
Oh yeah, definitely.
By law, he is required to disclose the information to the bank.
Yeah, definitely.
So that is the element of confidentiality. We have 3. 1 by consent of the client, 2 by law, and then the third one, I think I've forgotten the third one.
The third one by law, but still the consent of the client must be sought before you can disclose it.
Yes. Yes.
You can. Are you done, my brother?
Can you relate it to this?
Yes, you can relate it to this. But the requirement is you are to discuss whether the auditor will be liable if the audit is negligently done. You see, so your confidentiality statement too, you can bring it like a point, a paragraph, but the main focus will be on whether the auditors will be liable to the bank if they didn't do the work diligently, whether if they are negligent in performing the work. So this one, the question is trying to test you on the law of tort, which is the civil liabilities of the auditor. You have the criminal liability.
Oh, yes, you are right, sir. I think I get you right now.
Okay. You have the criminal liability and you have the civil liability. So that is what the examiner is testing here, the liabilities of the auditor. So this one, negligently is under the civil liability. The criminal liability is fraud. That one is fraud. So they are trying to, the examiner is trying to test your understanding on the liabilities of the auditor. So in your explanation, you must bring all these things, that the bank will be liable based on law of tort, and the bank must be able to establish that duty of care exists between the audit firm and him. Then the bank must be able to establish that duty of care has been broken. Then the bank must be able to establish that they have suffered the financial loss. Because as our brother Nathaniel said, because the bank will rely on the audit report to what? To give a loan to the client. I think this paragraph, you see, and the bank will rely on the audited financial statement as part of the terms and conditions in the loan agreement. So if the auditors perform the audit negligently, they may be liable to the bank based on the law of tort. Any question or any add up? Then we move to the next question. Any additions, any questions, any contributions? Can we move on to the second question? All right. Auntie Doris, let's go. Question number 2.
Question number 2. You have been recently promoted as the ethics partner in Famous Chartered Accountants, a licensed audit firm. At your first visit to the managing partner, he informed you of an appointment by Phobia Foods Limited and gives you a file to go through. You open the file and find a copy of an email from the managing director of PFL, that is the Phobia Foods Limited extract, which reads as follows. From Managing Director, Phobia Foods Limited, to Managing Partner, Famous Chartered Accountant. Subject: evaluation of business expansion plan and associated items. So it reads, congratulations on your offer of appointment as auditor cum advisor of our company. As discussed in our earlier meeting, Phobia Food Limited would like to open 3 more outlets, 2 in Sunyani and 1 in Sugakope. The necessary financing will be obtained through a new bank loan and the rescheduling of the payment of the existing loan, which is technically in default.
Let's go on.
Please, should I continue?
Yes, continue.
Okay. Your appointment and fees. Your audit fee will be 16,000 Ghana cedis for the year ended 30th June 2018. Your fee for evaluation of our expansion plan and advisory services in relation to obtaining a bank loan will be 9,000. For advisory services and business efficiency and strategic decisions, your fee will be 3,400 per month for the next 2 years. Shareholders and key management issues. 5 founding directors, each with equal shares, incorporated PFL, which commenced trading in 2009. I still maintain my original 20% holding. Then audit and account 2016 to 2018. Ofosu Mensah and Associate, a firm of licensed auditors, audited the accounts for the years ended 30th June 2016 to 30th June 2018 inclusive. The audit of PFL for the year ended 30th June 2018 was signed off on 16th November 2018 with an unqualified opinion, notwithstanding those qualified opinions had been published on the previous 2 years' account. The shareholders of PFL approved your firm's appointment at the annual general meeting held on 15th April 2019 for the year ended 30th June 2019.
Let's move on.
The funds raised by the new bank loan will be used for expansion of the business. Your firm is also expected to advise the company on the application for the new bank loan and the rescheduling of repayment of the existing loan in default. Yours sincerely, Managing Director. You are required: evaluate 5 risk considerations and issues for Famous Chartered Accountant that should be identified prior to accepting this engagement.
All right. Very nice and interesting questions. The requirement is you are to evaluate 5 risk considerations and issues for female chartered accountant that should be identified before accepting the engagement. All right. So let's start. So what are the risks that famous chartered accountants have to what? Have to consider before they accept this appointment? What are the things that they have to consider? So let's break the questions down paragraph by paragraph. So they are famous chartered accountants, they are licensed audit firm, all right? So at your first visit to the managing partner, the partner informs you of appointment by Phobia Foods Limited and gives you a file to go through. So when you open the file, you find a copy of an email from the managing director of Phobia Foods Limited. So the email read. So let's see the content of the email. So the managing director is congratulating the famous chartered accountant on the appointment as auditor and advisor of Phobia Foods Limited. So he's saying that as discussed in our earlier meeting, so it means that the engagement partner, the famous chartered accountant, has already met with the managing director of Phobia Foods Limited. So we'd like to open 3 more outlets. So the managing director is saying in the email that they want to open 3 more branches. 2 will be in Sunyani, and 1 will be in Volta region, which is Ogakope. So the necessary financing will be obtained through a bank loan. So you have to take note. So the finance to open the 3 more branches in Sunyani and Sogakope will be obtained through a bank loan. And the rescheduling of the payments of the existing loan, which is technically in default. It even means that this place, what does it mean? Let's digest the question before we start answering it. It even means that what? The company, they even taking a loan from the bank. And they are not even paying. The old one, the first loan they have 2, they are not even paying. And they want to reschedule the payment. And they were even in default, paying the old loan. So that means that should give you details about the companies. They even have a finance issues. Is that not the case? I don't have the financial issues.
Yeah.
Because if the new branches, the 3 new branches they ought to open, it will be financed with a bank loan. And they are even owing the bank. They have an existing bank loan that they even want to reschedule the payment. And they are even in default. That means they're having a liquidity problem. They're having a problem. All right. Let's see the audit fees. The audit fees, they've even mentioned the audit fees. Your audit fee will be what? 16,000 for the year ended 30th June 2018. Nathaniel, are you laughing?
Yes, so
why are you laughing?
They are deciding the audit fee for the auditor.
Yes, you see, the managing director have power, so he's even deciding the audit fee. Fixed fee, without even stating the basis how they be calculated it. No. So they fix the fee, 16,000 for the year ended. Now, for the evaluation of the expansion plan and advisory services, they are saying that, and in relation to obtaining the bank loan, we will pay you 9,000. You don't have any choice. We will pay you. Then the managing director is saying that what? For the advisory services and business efficiency and strategic decisions, Charlie, you'll be paid what? 3,400 each month for the next 2 years. So that means the fee is what? It's fixed. And they do not even state the basis on which they even calculated the fees. No. Fixed audit fee. All right. Let's go to the next paragraph. Shareholders and key management issues. So they have 5 founding directors. Each of them have equal shares, and the managing director, the business commenced since 2009. And the managing director is saying that he is still holding his 20%. Because if the founding members are 5, the founding directors are 5, and each of them have equal shares, it means that each of them will have 20%. Is that not it? So the shareholding structure of the company have not changed. It is the same since the commencement of the business in 2009. Okay. Now, audit and account for 2016 to 2018. So that means 3 years. For the past 3 years, it is Ofosu Mensah and Associates that have been auditing the firm. So they audited the account for the year ended 30th June 2016 to the year ended 30th June 2018. That is 3 years. So they've done the audit for 3 years. All right. Now, the audit of PFL for the year ended 30th June 2018 was signed off on 16th November 2018. And the opinion was what? Was unqualified. It means that what? Why you issue unqualified opinion? It means that what?
It reflects the true and fair view.
True and fair view.
The auditors of Ofosu Mensah and Associates, they are saying that the financial statement of Phobian Food Limited for the year ended 30th June 2018 is true and fair. There's no issue in the account. Everything is correct. But for the past 3 years, for the past 2 years rather, they were still issuing what? They were issuing qualified opinion. So it means that for 2017 and for 2016 and 2017, they were issuing what? Qualified opinion. It means that the financial statement for 2016 and 2017 is not true and fair. But in 2018, the auditors of Ofosu Mensah and Associates, they are saying that the financial statements of Phobia Food Limited is true and fair. All right, no problem. Let's move on. So the shareholders of PFL approved your appointment. So your appointment was approved on... Yes, Senior George.
I think you have to check the date. The date that we were mentioning.
The date
I
for...
think, the date for the qualified opinion.
Yes.
Was within 2016 to 2018 June. And the unqualified started after July to 20th June. So the period for the audit and accountability 2016 to 2018 is...
I cannot get you. I didn't get you. If you can come again, please.
What I'm trying to say is that...
Yes.
Yes, what I'm saying is that the unqualified opinion that was...
Oh, your network is not good. Your network
within the 2018 June, 1st July 20 to 30th June 2019.
No, I'm not sure. I'm not sure. Is that what the question says? Okay, let's read it again. The audit from here, the audit of PFL for the year ended 30th June, for the year ended 30th June was signed off on. It means that the audit was completed on 16th November 2018, and the report too was issued on that day with an unqualified opinion. So the unqualified opinion is for only 2018 financial year. That will be from 1st July 2017 to 30th June 2018. Is that not the case, Nathaniel?
Yes, sir.
Yes.
So it means that the unqualified opinion is for only 1 year. It's for the financial year and the 30th June 2018.
2018. Then the 2016 and 2017 was issued with qualified opinion.
And 2017 was what? Was the qualified opinion.
Opinion.
The audit for 2019 is yet to be done.
Yeah.
Senior George.
I'm okay, sir.
All right, thank you very much. The audit for the 2019 financial year, which will end on 30th June 2019, is yet to be done. And they are appointing a new auditor on what? On 15th April 2019. So the new auditor will now have to conduct the audit from July 1, 2018 to 30th June 2019. Is that not the case?
Yeah.
All right.
Yes, sir.
Okay, thank you, Senior. Okay, so they say that the funds raised by the new bank loan will be used for the expansion of the business. So your firm is also expected to advise the company on the application for the new bank loan and the rescheduling of repayments of existing loan in default. So you have to identify 5 risk considerations and the issues that famous chartered accountants might have to consider before they accept this engagement. There are a lot of risks and there are a lot of issues. Is that the case? There are a lot of risk in this particular case, and there are a lot of issues. There are a lot. So let's mention the first and move forward. So what are the risks and the issues that they have to consider before they accept this engagement?
So in this, there is we have advocacy threat.
Okay.
Yeah, in it, because the first aspect is the managing director of Obia Foods describing the fees, even telling the partner, the managing partner, that he still maintain his original 20% holding. In a way, he's telling the managing partner that if it comes to the annual general meeting, my vote's very, very important.
Okay.
So that is an advocacy threat, and telling them that your audit fee will be this, prescribing the audit fees.
I beg you, take them one so that you can get your point and write on. The audit fee too will be another issue. There's a risk.
Yeah.
There's a separate risk there. So if you blame them like that, you'll be handicapped.
Oh, okay. So meaning you can state the issue as it is from the statement. Then you now talk about the threat related to it.
Yes, you can do that.
All right, so that you can have one particular threat, but you can have about 2 different issues.
You can have about 2 different issues, yes. You can have, it's a risk. It's not a threat you have to identify the risk.
Okay,
The risk in conducting this audit.
Yeah.
The risk that famous chartered accountants will face in conducting this audit. And what they must consider before they accept the engagement. There are 2 different things.
Yeah.
Okay,
so let's say the first aspect, what they would have to consider before they accept the engagement. So can we say that they should have a discussion with the previous auditors?
Oh, that one is conk, definitely.
Yeah.
Because they were not the previous auditors.
Yeah.
And before you accept this, before famous chartered accountants will accept this engagement, they must have a discussion with what the old auditors. Is it not the Ofosu Mensah and Associates?
Yes.
Aha, they might have discussion with Ofosu Mensah and Associates.
Yeah.
So they must even review their, you see, first, the risk, one of the risks is that the company is into liquidation. I mentioned that one earlier. You see,
reputation.
Reputational risk is there. Reputational risk is there. Compliance risk is there. Because inherent risk is there. Because even the compliance risk is about they are not quite complying with the loan payment schedule.
Yeah.
They are even in default of the loan payment. So what shows that the bank will be able to give them another loan again. You see, so the risk is that even the company they're into liquidation. So famous chartered accountant must be very careful in accepting this engagement. There's a reputational risk because the company, they are not complying with the bank loan and their reputation will be damaged. Their reputation will be damaged. Are we okay? And even they're even dictating the work for famous chartered accountants. Now this work, they want. Who is talking? Today I don't want to be talking plain to you. Let's be bringing the issues out. This one, at this stage there, we are matured. We are going to write the exam next week. So this one, we have to bring the issue out. It's safest on the call. And okay, Auntie Angela, let me say it's now on the way. So what are the risks? There's a real risk on the audit fee. Fixing the audit fee be fixed by the managing director of the firm of Phobian Foods Limited. You as an engagement partner, how can you fix the audit fee for your audit client? And when you are fixing the audit fee, you must state the basis upon which you calculate your audit fees. You just say that the audit fee is what? It say your audit fee will even be what? 16,000. That statement is even wrong. You cannot decide the audit fee for the auditors. They have to determine their own audit fee. So there's a risk that what? The famous chartered accountants, if they will accept this engagement, based on the fee charge, based on the 16,000 that they are going to charge them, based on the 16,000 they are going to charge them. There's a risk that they may not be able to conduct the work diligently because the fee is already fixed. So what if they will require a service of an expert? Can they include that person in the audit fee? Because that provision is not made for that person in the audit fee. So this case, if they require the service of an expert to conduct this audit, they may not be able to require to engage that person to give his expert advice because the audit fee is already fixed. What are some of the issues again? I don't want to be talking plenty. The issues are many in the case. Who is talking? I'm listening. Yeah. Even see this paragraph. For the financial year and the 30th June 2016 and 2017, the opinions was qualified. That means the previous 2 years before the financial year in the 30th June 2018, they have issues in their financial statement. So before famous chartered accountant will accept this engagement, they must review the previous 3 years financial statement and see on what basis that the auditors of Ofosu Mensah and Associates, they issued what? The qualified opinion. And even the current year, which is the 2018 year, that the audit was signed off on 16th November 2018. That one, the opinion has changed. So what necessitates that change? So before they will accept this engagement, they must review the previous auditor's report. First of all, they must review their working papers, review their report, review the old financial statement to see what are the issues in that report before they accept this engagement. Maybe if like I'm part of famous chartered accountant, this engagement I will not accept it too. There's even a risk that they may be sued because they may be sued if the audit is conducted negligently, because the audits, they are going to use the information to obtain a bank loan, to finance the 3 new outlets that they want to open. And they even ask them to determine, I think that in the last paragraph here, they say your firm is also expected to do what? To advise. You are giving financial advice, corporate financial advice to your client on the application for the new bank loan and the rescheduling of repayment of the existing loan. So they are even assuming management, they're asking you to assume management responsibilities by advising them on how they go about acquiring the new loan and how they go about the rescheduling of the existing loan. So if this audit, the risk here is that if the audit is not conducted very well, if the audit is conducted negligently, famous chartered accountant can be sued by the bank. Any additions, any submissions? When you write all these things, the examiner cannot. Yes.
I've been off small. I don't know if you've spoken about the fact that the famous chartered accountant should contact the previous audit firm.
Yes,
okay.
It's Mr. Nathaniel who said that. Senior Nathaniel said that. Yeah. You write all these things, there's no way, if it is 5 months or 10 months, there's no way you will not get it. I hope you are good. Any additions, any submissions? Then we move to question 3. Okay, Sister Doris, let's move on to question 3. If Sister Doris is here, kindly move on to question 3 for us. Read the question.
Question 3.
All right. Sister Doris, you are not making submission. I hope you are okay.
Yes, please.
I hope you are following.
Yeah, I'm following.
Okay, all right. Let's move on.
Okay, question 3. Your audit client, Asuyebua Limited, has recently hired an internal auditor to deal with increased regulatory requirements. Afrakuma, the CEO of Asuyebua, has indicated that she believes the presence of the internal auditor will dramatically reduce the work that your audit firm will have to perform. She anticipates that this will have an impact on the audit fee required. Draft a report indicating factors that will influence the extent to which external auditors will rely on the internal auditors' work as per the requirements imposed by ITSA 610 using the work of internal auditors.
Okay, thank you very much. So we've learned that. Mr. Christian, you are welcome. I don't know if you are on the call already. Mr. Christian Sogwe.
Thank you.
All right, you are welcome. I hope everything is fine. How is the going?
But as I told you the last time.
Don't worry, you'll be fine. Your 50 mark is assured, eh? Just follow us.
Yes.
Yes, your 50 mark is assured.
Okay. Thank you.
No matter what, you get your.
Thank you very much.
All right.
Thank you.
Okay. So the requirement is you are to draft a report indicating factors that will influence the extent to which the external auditors can rely on the work of the internal auditors. We learned that external auditors can use the work of the internal auditors when they are coming to conduct their end of year audit. Now, the requirement is what are some of the factors that the external auditors have to consider before they use the work of the internal auditors? Let's mention them fast and move forward. What is the first one? You are going to write a report too, and I believe you know the report format.
Form 2.
All right.
The date, the subject.
Okay. All right. That one I won't write it. So report, as at this stage, you should know report format. It's a report. Pay attention to the question. What the question is asking you to do. They say you should draft a report. So you know it's a report you are writing. So you should put it in a report format. Don't just, if you stand up and stating the point, you will not get the full mark. The examiner will have mercy on you, but you won't get the full mark. Write a report. All right.
So in the report, should we bullet the points or we should just write them like essay?
Oh, yes, you bullet the points. What is essay? Bullet the points, the examiner will mark. You see, that is one way to pass the exam. If you write the thing plenty, the examiner have to be reading and be making meanings to what you are writing. So write it in the report, in the body of the report, bullet it. Write it point. You are good to go. So you know you are from to the date, then the subject. So what will be the subject here?
Using the work.
Nathaniel, we can hear you. So using what?
Using the work of internal auditor of factors that external auditors can rely.
Before using the work of the internal auditors. Is that what it is?
Yeah.
All right. So after that, you have to bring what? Your introduction. Is that not it?
Yeah.
So introduction should be something brief. So how will you write the introduction? We say write a report. So my brothers and sisters, write a report. There must be introduction. So how will you write the introduction?
This report seeks to throw more light on some factors that can influence the extent to which internal auditors can rely on internal auditors, as imposed by the standards, the international standards for auditing.
All right, thank you very much. So now let's take the factors. So what are some of the factors?
So can we say the qualification and
my senior Nathaniel?
Yes, sir.
I don't like that. Can we see? I don't know. I just don't like it. After even if I say you cannot see.
Okay. So one of them is the qualification of staff.
The qualification of the internal audit staff.
Yes, internal audit staff. Yeah, okay. I think to say.
So the independence of the internal auditor.
The independence of the internal audits auditors. Okay.
Sir, the independence of the internal auditor is objectivity.
Objectivity.
Independence of the
And then the quality of internal audit reports.
Exactly.
Yeah.
The quality of the report. The scope.
And the professional due care exercise.
All right. Okay. And the scope of the audits, the areas that the audit has covered. You look at the scope. If the scope fall within what the external auditors are also coming to do, then they can use that report. All right. Thank you very much. So let's move on to question 4.
Sir,
Mr. Robert.
There should be a routine communication between the auditor and then the external auditor.
Oh, yeah, definitely. Yes. So in that case, the external auditors the internal auditors are required to give a copy of their report to the external auditors. So that
time to time.
Yeah, that communication is there. Yes. You know, the internal audits work, they normally do their work report on quarterly basis. So every quarter, their reports, they are mandated to give a copy to the external auditors so that the external auditors will know what the internal auditors are doing. So that communication should be there. If that communication is there, then the external auditors can rely on the work of what? Of the internal auditors. All right. So you write as many as you can to grab the maximum mark to pass the exam once and for all. So let's move on to question 4. Mr. Doris.
Question 4. Money laundering has become a significant threat to the world's political and economic order. World leaders are collaborating and cooperating in fighting money laundering. However, criminals are maliciously clever and, in some cases, ahead of law enforcement agencies. Every human being has to contribute to the fight against money laundering. Required. Assess why money laundering poses a big threat to the world's political and economic order. 5 marks. Discuss 5 ways in which Ghana is contributing towards fighting money laundering globally.
Okay, thank you very much. But before we answer this question, let's do some quick revision here before we move on. Let's do some quick revision before we try and see if you can answer this particular question. Money laundering. What are the stages of money laundering? How many stages do we have?
3.
So we have 3 stages. So the first one is what?
Placement.
So the first one is placement. That one, placement talk about what?
When you are involved in cash transactions.
When you are involved in cash transactions.
Yeah.
Is that what the placement?
Introducing the illicit money or trading into cash transactions.
Okay. So the next one is what?
Laying.
Laying. This one talks about what? The laying, what does it mean? What does it talk about?
Passing the money through various layers of transactions.
All right. So multiple bank transactions. Is that not it?
Yeah.
Then the third one is what?
Integration.
Okay. Integration. The integration, what does it mean?
You are bringing the money back to the economy.
So you are trying to do the activities such as what? You're trying
real
to
estate. Put it into genuine business.
Okay, you are trying to engage in real estate businesses. All right. Okay. So these are the 3 stages. These are the 3 stages. Now, what do I want to ask about money laundering again before we move on? What do I have in mind? Money laundering, it came in November. Money laundering came in, I think, November 2023. Yes. They gave some practical examples, some practical questions over there for the candidate to identify the stages of the money laundering activities. That's November 2023. So you don't know what the examiner can bring. So you are to assess why money laundering poses a big threat to the world's political and economic order. Then you are to discuss 5 ways in which Ghana is contributing towards fighting money laundering. Do you agree that money laundering poses a big threat to the world's political and economic order? Do you agree?
Yes, sir.
Yeah, Mr. Robert.
Yes.
You agree. If you agree, you have to defend your stand. What will you write to get your 5 marks here? That's what I want you to tell me.
So I agree because
fighting money laundering in this thing. Assess why money laundering poses a threat to world political and economic order.
Yes.
I said in the this in how will I put it? Ammunition that people import to the country.
Okay.
They are all criminal activities. So they import this thing and they give it to the politicians.
Yeah, Mr. Roberts, we can hear you loud and clear.
Yeah, the importation of this ammunition to the country is also a form of criminal activities. So in the event that they bring, they sell it to the politicians, and when there is any political instability, that is where they use to.
Okay, thank you very much. Yeah, your point is very, very relevant. What again? Save as you are saying something. You wanted to talk before our senior gave his valid point. So now the floor is yours. Save as if you can hear me, kindly make your submission, please.
Okay, on the first point, I wanted to make an issue concerning the ammunition, as he said, that those who engage in money laundering, they used to acquire those things, and when there is political unrest, then they use it to, trade the life of people. Okay. And economically, money laundering causes more money in the system that causes inflation, so it brings the economy into disorder. Also, it causes the interest rate and at the bank to also increase, or it affects the exchange rate and the interest rate because there's more money in the system. So, how am I going to put it?
Oh yes, that is it. Because there's more money in the system, so more money will be chasing fewer goods. So it will cause what? An inflation. Is that what you're saying?
Yes, that was the second point I make.
Yeah, so it's a very valid point. So the other one, is there 5 ways in which Ghana is contributing towards fighting money laundering?
Yeah.
Nathaniel, we can hear you.
So in this case, can we look at it from the perspective of discuss 5 ways in which Ghana is contributing towards fighting money laundering globally? The appointment of the office of the special.
Oh yes.
So one can be the appointment of the office of the special prosecutor.
Yes, to fight corruption.
Serving as the anti-money laundering reporting officer
for Ghana.
Yeah, for Ghana.
Yes, but that one too, every organization, every company, the Ghana have they have an act on that.
They
have, money laundering act. So that act is also there to regulate this the money laundering activities. And in the act, every company you are required to appoint anti-money laundering reporting officer, especially banks. Especially banks, you are supposed to have that officer there. So that officer will report. So everybody in the organization will report to that officer if there's any suspicion of what money laundering activities. Yes.
I'm somehow skeptic about the office of the special prosecutor in the fight against money laundering. In the sense that when you look at the requirements or the responsibilities of the special prosecutor, I think he is to fight corrupt and corrupt activities.
Corrupt practices,
and practices. So even when we take Madam Dapa's case, for instance, where people are alleging that there are issues of money laundering, the special prosecutor has to refer the case to IOCO to investigate the money laundering part. So if it is the duty of the special prosecutor to investigate or fight money laundering, I don't think he will refer the case to the IOCO to do that, because it's IOCO that is established to fight those criminal activities relating to finances. So it is rather establishment of EOCO that is for the fight against money laundering.
Yeah, thank you. Thank you very much. Thank you very much. Thank you very much. But the Office of the Special Prosecutor too can also
because if you look at the point, he said in which Ghana is contributing towards fighting money laundering globally. Is contributing. So you can have already established office there, but in what other ways is Ghana contributing?
Oh, yes.
Fighting money laundering. So the creation or the institutionalization of the Special Prosecutor Office is part of the contribution towards fighting these illegal practices.
Yes. So the two you can stay
yeah.
the two, both the SP and the EOCO. Yes. You can stay the two. Yes. Well, the OSP is there. If he cannot fight it to the latter, then he can refer it to the EOCO. So it's a way of what fighting the money laundering activity. Yes. So at least get your 5 points for your 5 marks. All right. Let's move on. Question number 5. Mr. Doris, let's move on. Question 5.
Question 5. Although auditors can incur civil liability under various statutes, it's more likely that they will incur liability for negligence under common law, as most cases against auditors have been in this area. Therefore, auditors must be fully aware of the extent of their responsibilities to minimize the danger of professional negligence claims. Required, discuss 5 steps that auditors should take to minimize the danger of claim against them for professional negligence.
All right. This one is very, very, very simple and straightforward. We all know that auditors suffer some form of liabilities. They also suffer some form of danger of claims. So we just discussed that, which is in the liabilities is in the form of the criminal liabilities and the civil liabilities. We just discussed that. So now the question is asking you to discuss steps that auditors can take to minimize these liabilities. You have to discuss 5, the steps that auditors can take to minimize their liabilities. Very, very simple. So let's mention them. Mr. Doris, give us the first one. What are some of the steps that auditors can take to minimize their liabilities?
I think one of the steps is that they have to follow the appropriate regulatory requirements, or they have to follow the right ways of doing their work in order to avoid incurring any liability.
Thank you very much. So what the second one? This one, just give us the 5 already. It's like you are on top of this one, so just give us the 5.
So they can also ensure their liability.
So that is professional indemnity insurance. Professional indemnity is PII. Professional indemnity insurance. Yes, they can also insure. What the third?
I also want to suggest that the auditors should communicate their responsibilities clearly in the engagement letter.
Yes. So the engagement letter must specify their responsibilities and that of management. Is that not it?
Yeah.
Yes.
And they can also issue a disclaimer in the engagement letter.
Okay. They can also issue a disclaimer in the engagement letter. Yes.
Yeah.
There should also be client acceptance procedures.
Okay, clearly acceptance procedures.
Can they also set a cap beyond which?
Please, it's client, not claim. Client acceptance procedures.
Come again.
Client acceptance procedures.
Yeah, client acceptance procedure. Okay, all right. Somebody's also saying something. Someone say they
can they set a cap, CAP, beyond which that they will not be liable to that claim that probably they will pay as a result of their negligence.
Can they do that? Let's discuss.
Can they set a cap?
Yes, I get the question. So I'm asking the class. Is that possible to do?
Because I think I read it in the manual. That's why I'm trying to.
Okay. All right. So if you read it in the manual, then I think it will be.
I think.
Yeah,
I think. Yeah, I think that is when the government come inside. You see, most of the time they believe that these big companies believe that auditors have money. So in case of any issue, and they can sue them. So when the government comes into, come out with a cap and such an amount that would allow maybe the client to also sue and not to sue the auditors. That is the liability capping or caping, something like that.
Okay, yeah.
That's what my brother is trying to.
Yeah. Thank you very much. Thank you very much.
Thank you very much, my bro, for polishing it for me. But I'm enjoying the class. Sometimes you read a thing, but God, the things are plenty. Then you don't know what to say.
What again? There is one that you guys are not telling me.
I also want to suggest again that the auditor must evaluate the risk associated with the work, so that if it is beyond the auditor's work, they can reject it.
All right. Yes.
And they must also look at their own qualifications before accepting the engagement.
Exactly. There's one simple one that you guys are not telling me.
Seek legal advice.
Quality control.
Quality control.
Quality
control. Okay. Quality control. Very, very important. Quality control. All right. Let's move on to the next question. Question 6. Let's move on. Sister Doris.
Question 6. Your firm has recently completed the audit of Jackson Company. After extensive discussion with the company's management, the audit opinion has been qualified in respect of the auditor's inability to agree with management on the appropriateness of a provision for obsolete inventory.
All right, you wait. Let's digest this paragraph. What the paragraph say? Cannot even see well. Somebody should digest it for me. What are they saying? What the paragraph talking about? So, okay, the opinion for the audit is what? It's qualified. It's qualified opinion. The reason being that what? So the basis for the opinion is that what? Inability to agree with management on the appropriate what? Appropriateness of provision of obsolete inventory. So this one, there was a fight between management and auditors. So because of that, these people have qualified their report. All right, so let's see the second paragraph. Let's go.
The managing director has informed you that the company intends to change its auditors and engage the services of a small local firm of accountants. He informed you verbally that the reason for their decision is the disagreement over the provision for inventory obsolescence. Jackson Company is convinced that the new auditors are more likely to accept the accounting policies of management. You have received a letter from the new auditors inquiring if there are any professional reasons why they should not accept appointment as auditors of Jackson Company. Required, in view of the attitude of management towards your firm, discuss the factors which the new auditors need to consider before accepting the appointment. 2. Explain the ethical implications for the new auditors if they accept the appointment as auditors.
This one is very, very simple. So let's move on. So what are the factors that the new auditor have to consider before they accept the engagement to audit Jackson Company Limited? 3 marks. This one is straightforward. I don't even want to talk plenty again. This one is straightforward. Who is coming?
I think one is not really in this matter, but I think one is whether they have been unpaid audit fees. Yes.
Oh yes,
before
definitely.
they should
Yes.
accept it.
Yes, they have to look at that because they are that means they are the Jackson Company Limited. They are changing the old auditors. So before the new auditor you accept the appointment, you have to look at and see whether if they have been paid, if the old auditors have been paid in full. But the question is talking about in view of the attitude of management towards your firm. Discuss the factors. So at least let's state something that is relating to the case. That's
So hello?
Yes.
Yeah, so I think one of the points or the factors that a new auditors need to consider is the integrity of the clients.
Okay.
Yeah, are they honest? They follow the financial reporting framework.
Okay.
They have to consider that as one of the factors, and also to look at the ethical cost.
Okay, thank you very much. So the integrity of the client. So the treatment of the inventory, of the obsolete inventory. Yeah, somebody say something. Mr. Clement. Mr. Clement, we can hear you, please. All right. So the integrity in this particular case, if you look at this particular question, the integrity of the client is very much. It's the first thing you have to even write. Because you must see whether if the client, they follow the appropriate standards in what? In recognizing or in what? Recording the obsolete inventory in the financial statement. If they want to relieve the old auditors of their duty, so they want to appoint you now as the new auditor, because of the disagreement that they had with the old auditor on the treatment of the obsolete inventory, you must look at it. The inventory, does it follow the applicable financial reporting standard? The treatment that management is stating, does it follow the applicable financial reporting standard? Which standard talk about the inventory?
IS2.
IS2. IS2. So it says that what? Inventory should be measured as what?
The lower of cost, net realizable value.
The lower of cost and the net realizable value. We take the two. This one is obsolete inventory. So you must find out. So definitely you are going to communicate with the new auditors. You find out from them. So the treatment that management is stating, that is it in the requirement of IAS2. So you must evaluate all these things before you accept the engagement. You see, and now they're saying that what they want to change 8 auditors and engage the services of a small local firm of accountants. And if you look at the third paragraph, they are convinced that the new auditors are most likely to accept the accounting policies of management. So this place, the examiner is trying to test you on the IAS2, the requirement, the IAS2. So what are the ethical implications for the new auditors if they accept the appointment? Because there is a clause here. There's a clause here. Jackson Company. Jackson Company, they are convinced that what the new auditors will accept the accounting policies. This will even tell you that the accounting policies they are using to recognize the obsolete inventory is not a requirement of IAS2. if it should be a requirement of IAS2, the old auditors will not issue what? They will not issue a qualified report. They will not issue qualified opinion. So that should tell you that the accounting policies that management are using to treat the obsolete inventory is not in compliance with IAS2. So they are saying that they believe that the new auditor will accept their accounting policies. So if the new auditor should accept this appointment, what will be the ethical implication? For 2 marks. So at least you stay to.
I think there will be intimidation.
Don't think, my brother, don't think.
Okay. There will be intimidation threats because for the fact that they are convincing the new auditors to accept their way of preparing their accounting statement, which is not in accordance to the standard.
All right, thank you very much. So there'll be a form of.
That is what I'm thinking.
Yeah, your thinking is right.
Okay.
Your thinking is right. So because
they are independent as a auditors too.
Their independency too, will be what? Will be compromised, yes. Their independency too will be compromised. Because Jackson, they are convinced. Look at the word, they are convinced. So if the new auditor, you come and say, oh, Master, I'm not, your accounting policies is not in line with the applicable financial reporting standard, then there will be another disagreement again. Then it's very likely that they will sack you too and appoint another person. Because the management, their notion is that the new auditor is what? Is a small what? Local accountant. They're small local firm. So they believe that they will accept the accounting policy. So there will be a form of intimidation there. The independency of the new auditors too may be compromised. All right.
For the fact that they are being classified as a small local accounting firms, it will also affect the payment issues, charging of the audit fee.
Exactly. The audit fee payment there will be an issue there. All right. So let's go on question 7. Question 7, then we are done with the question number 1. Then we are done with professional and other considerations. So question 7, is you are to explain audit expectation gap and the elements in the gap. Then you should recommend 2 ways of closing the gap. So what is audit expectation gap? And what are the elements in the audit expectation gap? This one, I want a lady. Guys, there your voice is too much. It's too much in my ears. So I want a lady. My ladies, don't disappoint me. Don't let the guys overshadow you. Mr. Doris, I hope you are there. You cannot tell me that you are not there.
Please, I'm trying. I think that expectation gap is what auditors are expected to do and the actual work of auditors. The difference between what auditors are expected to do and the actual work of auditors. Yes.
Kindly take it again for me, please. Kindly take it for me again. Mr. Dory, if you are talking, we cannot hear you. So kindly unmute and talk. You said the expectation gap is what? Somebody to bail Sister Doris from you.
Maybe a guy or...
Oh, you didn't hear me.
No, your mic was off. We cannot hear you.
Oh, okay. So I was saying that I think the expectation gap is the difference between what auditors or what the public expect auditors to do and the actual work that auditors do. That's the expectation gap.
So what the public think, what they think that auditors are supposed to do, and the difference between that and what the auditors are required by law and the standards to do. All right. So what are the elements in the gap? What are the elements in the gap?
We have the standard gap.
So we have the standard gap. That one talks about what?
This one talk about the auditing is a prescriptive.
The auditing is what?
It's a prescriptive.
Predictive way of
predictive.
Of it.
Yeah, predictive.
So the outsiders think that they can predict the auditing standards. Is that it? Then the second one is what?
Performance gap.
Performance gap. This one talk about what?
The auditing standard has fallen.
The performance of the auditing has fallen below the standard, below the required standard. The third one is what?
Liability gap.
Liability gap.
Liability gap. What does it talk about? Liability gap, what does it mean? Liability gap, what does it mean?
The auditor is blamed from his wrongdoings.
The auditor is blamed for what?
From wrongdoings.
I don't get it well. I'm a little bit confused. So if you can explain for me to understand.
What I mean is that the auditor should be liable for any negligence.
Should be liable for any what?
Negligence.
Oh, okay, all right. So that's what the outsiders think, that the auditor is liable for not dictating any all the misstatements in the financial statement. And if anything has happened, if there is any fraud, the auditor is the one that will be liable for the fraud. That's what the outsiders think. All right. So how do you close the gap? Closing the gap.
Sir, please, I want you to help me some more concerning the standard gap. Does it mean that the public or the users of financial statements believe that the auditing is standard, like they can predict how it should go?
Oh, yeah.
So if the event that the auditor could not do what is expected to do, then he has not done his work well. Is that what?
Yeah, that is it. You see the standard, yeah, that is it. That's exactly what is it. So the outsiders think that they can predict the auditing standards. So they will use that to judge the auditor because of what that predictive mind they have, that the standard, they can predict it. So they'll use that mind to judge the work of the auditor. Meanwhile, that is not what the standard is talking about. That is not what the standard is talking about. So that's what you said, that's exactly the standard gap. So how do you close the gap? Closing the gap. How do we close the gap?
By educating clients or the shareholders on, or the users on the responsibilities of the auditor.
And that of management. You educate them to know that it is management that is what they have the responsibility to detect fraud and error, not auditors. All right. Now what again?
The auditing profession is regulated by international standard.
Okay.
That ensures that the procedures are complied with.
All right. Okay. So in Ghana, ICAG have to do a very good job because they are the one that regulates accounting and auditing practices in Ghana. So they must help to sensitize the public. Then there's one group again that can also help to close the gap. AC, Audit Committee. They can also help to close the gap. They also have the responsibility to make sure that the gap is closed. They educate the public on what auditors are expected to do. All right. So we are now done with question 1, audit of historic professional consideration and professional and other considerations. So let's
Please,
start.
what will the AC do to bridge the gap?
It's all about education. It's all about education.
So it falls under the first point. Huh?
Oh yes. So that the ICAG can also help to educate the public, the audit committee. They also have the responsibility to, yes.
So the only point there is education, because all of them are educating.
Yeah. So in explaining the education, you have to mention the ICAG and the audit committee. That's the only point. The other point, somebody mentioned the other point that the auditing is, somebody mentioned some international standards. Who, I don't know who make that point, who make that submission.
We have to make sure that the audit work is supervised or governed by the standards.
The standards, yes.
Okay.
So let's move to question 8. So we are moving to audit of historical financial statement, which is the auditing proper. So let's go on. Auntie Doris, read the question 8 for us.
Question 8A. Assurance Co. is a manufacturer company. The draft financial statement recognize profit for the year to 31st July 20x4 of 23 million, and then 20x3 is 33 million. A total asset of 450 million, and then 20x3 455 million. So property complex. In September 2004, a natural disaster caused severe damage to the property complex housing the Aspars head office and main manufacturing site.
This one,
for health and safety.
This name, it should be assurance. It should be assurance because it's the company is assurance company, so it should be assurance. Apart from that way, let's go on.
Okay. For health and safety reasons, a decision was made to demolish the property complex. The demolition took place 3 weeks after the damage was caused. The property had a carrying value of 60 million at 31st July 2004. A contingent asset of 80 million had been recognized as a current asset, and a deferred income in the assurance statement of financial position at 31st July 2004, representing the amount claimed under assurance insurance policy in respect of the disaster. Required, comment on the matters to be considered and explain the audit evidence you should expect to find during your review of the audit working paper.
All right. So this is question 2 and your question 3. This is where the problem lies.
Okay.
Hey, Senior Richman. Richman, are you there?
Yes, sir.
You are welcome.
I do. Thank you, sir.
Why you go hide?
I did. I know go hide. I did.
We will be fine. We are fine. We are fine already.
Yes, sir. Thank you.
We are fine already. So your question 2 and your question 3, audit of historical financial statement. This place, you need the knowledge of the standards to answer the questions here. If you don't know the standards, my brother, it will worry you. But even if you don't know the standard, you don't know the standard. If you come to the accounting issue, you can just say that maybe the treatment may be in sharp contrast to the applicable financial reporting standards. But if you know the standards, you can go ahead and state it that according to standard A, B, C, D, according to IASD, the standard says A, B, C, D. You can state it nicely. The examiner will be happy with you and give you the mark. But if you don't know the standards too, at least try and identify the issues in the statement, the issues in the case. Then if you don't know the applicable standards relating, the issue is relating to, then you can see that, oh, the treatment may be in a sharp contrast to what? To the applicable financial reporting standard, because you don't know the standards. And at this place, you need the knowledge of the standards to answer these questions. Question 2 and 3. If they bring you audit reports, oh, that audit report to at least you need question 2 and 3, audit of historical financial, you need the knowledge of the standard. So let's do our best to at least have some of, there are some standards when you are going to write the exam, you must know them. One is IAS what? IAS 10. IAS 10 is about what? There are some standards. If you are going to sit for this exam, you must know them, no matter what. You must know them. IAS what? IAS 10. IAS 10 is about what? Why am I writing 110? What does IAS 10 talk about?
Events after the
reporting period. You must know it. Then IAS 37.
As provisions, contingent asset.
IAS 37, you have to know it. Provisions, contingent assets, and contingent liabilities. Then you have to know IAS 8. IAS 8 talk about what?
Changes in
policy.
Accounting estimate
policy.
You must know it. Very, very important. IAS 24 talks about what?
Related parties.
Related parties.
Disclosures, yes. What other one again? What other one again? You have to know. Definitely. These four, this one they are, you have to know them. You have to know them before you.
PP.
PP. Is that not IAS 16? No, is it 16? PP is what standard is that?
Yeah.
IAS 16. Before you have IFRS 16 too.
Yes,
IFRS 16 is the lease.
At least.
IFRS 16 is the leases.
Yeah, lease. Yeah, leases.
IAS 16 is the PPE.
Yeah.
Yes.
They are brothers and sisters.
They are brothers and sisters. Okay. Then which standards again? No matter what, if you are lucky, they may give you. I think the last diet they didn't bring any advanced standard. They didn't bring any corporate reporting standard. There are some standards they only come in corporate reporting. IAS 19. 19 talks about
employees benefits.
Employees benefit. Then IFRS 2.
Share-based payment.
Share-based.
Share-based payment.
These two standards will always come in corporate reporting. They are only for CR. They are not for FR. So if you are lucky or if you are not lucky and they bring any of these standards. I think July. Is it July? No, it was March 2023. They brought IFRS 2. And then I think maybe before March, they brought IAS 19. I think maybe December 2022, they brought issues on IAS 16, IAS 19. So the standards, you need to know them. But this basic one, IAS 10, IAS 37, IAS 8, IAS 24. Which standard talks about IAS 38 is what?
Tangible assets.
Intangible assets. Yes, you have to know. Mr. Christian, your device is giving me feedback. All right, thank you very much. Then
do you say 28 or 38?
38.
38 is not intangible asset though.
It's what?
What?
Intangible asset.
38 is intangible assets.
Oh, okay. I thought it's 28.
No, 28 is separate financial statement.
Yeah.
That's confused.
Yo.
The 28 is investment in associate too.
It's investment in associate.
Yes, and joint ventures.
Okay. So which one talk about separate financial statement?
27.
27.
Yeah.
Charlie, so far you say you lost.
Oh, me, I did back.
The IAS 36 talks about what? Is it?
Impairment.
Impairment. Yes, impairment. Yes. So these ones, you must know them. 36, 38, especially provisions. They like bringing provisions, Papa. I don't know what the examiner like about provisions.
And the IFRS 5.
That is IFRS 5 is talk about what? No, current asset held for sale.
Yeah, held for sale.
This ones, you must know them. At least you will see one or two in your exam. You will see one or two. Provisions, they are the life provisions. November 2023, they brought provisions. I think before that, they brought provisions. So provisions there, they like it. No matter what, you must know provisions. All right, so let's move on.
In this one, we are reading Christ provision.
Is it provision?
And there's a contingent asset.
Yeah.
Okay.
There's provision in it.
There's provision in it. And there's even an impairment. I saw some carrying values somewhere. So that so the requirements of the question is you have to do what? You have to comment. You see, if they ask the question like this, then you are dead. Comment on the matter. Comment on the matter to be matters to be considered, and the evidence you are expect to find during your review. So this is a review question. During your review of the working papers. You have conducted the audit already. You are doing review before you report. So review of the working papers. You must comment on the matters that you will be considered. And you have to explain the audit evidence that you expect to find. So what is the key issue in this question? Let's digest the question before we move on. When you start seeing what figures in the question, what should come to your mind?
Issues of material.
Issues of materiality should pop up in your brain. Yeah. Start seeing figures. Know that you are going to be doing some calculations on materiality. Very, very important. Let me see what is in the chat. Somebody says something. Okay, all right. Good. So in the question, we were told that their profit for the year ended 31 July 20S4 is 23 million. That of 20S3 was 33 million. It said that the profit has reduced from 33 million to 23 million. Then the total assets for 20S3 is 450 million. That of 20S3 is 455 million. You can see that there is a reduction in the value of the total. No, yes, there's a reduction of what? From 455 to 450.
5 million.
5 million has reduced in the value of their total assets. Their profit has also reduced. So the issue is on property complex. So in September 20S4, now, what is the financial year end for Assurance Company Limited?
31st July 20S4.
So their financial year end is on 31 July 20S4. So that is July 20S4. Now, the issue happening to property complex occurred on September 20S4. So something should be popping up in your mind. What should be popping up in your mind?
IAS 10.
IAS 10. Event after reporting what? Reporting period. All right. So a natural disaster occurred, caused severe damage to the property complex, housing the assurance head office and main factory site. So for health and safety reasons, a decision was made to demolish the complex. So the demolition took place 3 weeks after the damage was caused. So the property had a carrying value of 16 million as at 31 July 2084. So Assurance Company Limited, the accountants, what is he doing? He has recognized a contingent asset of 18 million as a current asset. A contingent asset of 18 million has been recognized as a current asset and as a deferred income in the assurance statement of financial position. So the 18 million was recognized twice. So first one was recognized as a contingent asset, then again as a deferred income, representing the amount claimed under their insurance policy. Good. So you are required to comment on the matters and explain the evidence you are supposed to gather. So what will you write? What will be your comment? What will be your comment?
Okay, so the first issue will be about when the disaster occurred. Okay. And either it should be disclosed in the financial statements or it should be recognized. That is the first matter that I will look at.
No, tell me that. Tell me the way you write it.
And that is what I just said.
So you tell the examiner that's the first thing you look at. Don't worry. The English will come in the examination hall. That one there is came.
I've told you that. I've told you the explanation is between the paper and the pen.
The most important thing is you know what you're explaining. That's all. The other ingredients will add up. The of is to those who need to add up. So you say you look at what?
The period that the disaster has occurred. So okay. Within the month of September, does it qualify it to be recognized or to be disclosed in the financial statement?
What do you think? You said does it? It's like you're asking question. Or does it? That's the reason I'm asking. What do you think?
Yeah, I understand you. It will be disclosed.
It should be disclosed in the financial
statement. Yeah, but one challenge that I'm facing based on my thinking is that they're saying that a contingent asset is recognized. Meaning, and the contingent asset is recognized in respect of the disaster because they are relating it to the insurance policy that they had. So if the contingent asset is recognized, then it means the event must also be recognized, thereby adjusting the property, plants, and equipment in the financial statement.
Let me say something before we move on. What the treatment they have done. You see, the question is you should comment on the matter that you consider. So you look at it. The treatment they have done, is that the right treatment according to the standard? Are you getting me? Based on your understanding of the standard, what they have done, is that the right treatment? That's what you are going to comment about.
Okay.
You see, the first thing you start with the materiality. The carrying value of the property complex is 16 million. It means that
is it material to the
financial statement because the property was there. The property was there before the financial year ends, and the carrying value will be what? Will be part of the assets of the company. Is that not it? So you first have to talk about whether if the value of the property is material to the financial statement. So in this case, you calculate your materiality. So that will be 16 over what? What the total value of the assets of the company?
450.
450 by 100. What will you get?
3.5.
3.5%.
Yeah.
This value, is it material to the financial statement?
Yes, it's material.
It's material to the financial statement. That's the first sentence you write and get your 1 mark. Now you come to the accounting issues. You come to the accounting issues. The event, like as you are saying, the event is a non-adjusting event. Is that not it? But before that, you write your English plenty. For you to get the mark, you write your English. It's 7 marks. So it's 7 marks. So before that, you write your English that according to IAS 10, if you know, according to IAS 10, events after reporting period, and the other auditing standards is 560. It talks about what? 560 talk about what? 560 talk about what? Subsequent event. Subsequent. I told you this question is on review. The question is on review. So subsequent event. So this place you do MARA. This place you do MARA. You check materiality. You check the accounting issues. You check the risk. Then you talk about the evidence. That's what the question is asking you to do. The question says you should first comment on the matter first. Then the audit evidence. So comment on the matter is you have to check the materiality, you check the accounting issue, you check the risk involved, and the last one is the evidence. I think we are following.
Sure.
All right.
Yes,
okay, let's move on. So now we just calculate the materiality and realize that the issue is material to the financial statement. The property complex is material. The carrying value of the property complex is material to the financial statement. It's 3.5%. Now, let's talk about the accounting issue. Should it be recognized in the financial statement or it should be disclosed as a note? But before that, you state, if you know the standard, IAS says that natural disaster is what? Is it an adjusting event or non-adjusting event?
Non-adjusting event.
Non-adjusting.
Non-adjusting event.
Be disclosed.
Let's comment. Let somebody comment before I come in. If I'm saying the thing plenty like that, it's no good. Anti-success. I'm sure you want to help us.
So
Mr. Nathaniel, is this to?
Okay. So we can start by saying that the reporting date for Assurance Co is 31st July 20x4.
Okay.
That September 20x4, after the reporting date, some events occur. These events are non-adjusting events in line with.
You must state the event too. You must say that.
IAS 10. Oh yes. I'll state it. So,
okay, so state it for us. We are learning. So
okay, so the non-adjusting event or the event that occurred was a natural disaster, which caused a severe damage to the property complex of Assurance Co. Limited in September 20th. And this requires a disclosure in the financial statement. The materiality, so we will be looking at the 16 million in regards to the total assets. The materiality for the carrying value on the total assets is above the materiality threshold. And As a result, they are significant to the financial statement. Required full disclosure.
Okay.
So that is for the property that there is a carrying value. In accordance with IAS 37, provisions, contingent assets, and liability, there are two recognition criteria before contingent assets or provisions, liability can be recognized. The amount should be measured reliable, and there should be a constructive, or it should be constructive or legal for either the contingent assets. And once any of these two is met, then it fits the recognition criteria for contingent assets to be recognized. So when I'm done with that, before I will now come to talk about the evidence that should be obtained.
All right. So let me find out. The contingent assets, should it be recognized? And the deferred income, should they be recognized in the financial statement? You just mentioned IAS 37 provisions.
Yeah.
And you gave the basis on which you can recognize a contingent asset. You can recognize a provision. Now, they are saying that the treatment they have done is that even though the event is a non-adjusting event, they went ahead to disclose a contingent asset of 18 million, and as well as a deferred income of 18 million in their statement of financial position.
It's not that they disclose, or they recognize.
They recognize,
yes.
They recognize, They recognize the contingent assets of 18 million, and likewise recognize a deferred income of 18 million. Their assumption is that that is what the amount they have in the insurance policy. Because of that, they can recognize them. That recognition should at least be maintained in the statement of finance. Is it in line with the requirement of IAS 37?
One is that the amount should be measured reliable, and so we have the amount there.
Okay.
Which they said is recognized as a current asset and as deferred income in the assurance statement of financial position, representing the amount claimed under insurance policy in respect of the disaster. So it means that there is some level of certainty of the amount that is measured reliable. So that is where the auditor would have to obtain sufficient and appropriate evidence, back that claim in that regard. But I think, in my opinion, that looking at it is constructive, but it should be recognized in the following year, but disclosed in the current year.
Okay, thank you very much. So what you are saying is that the 18 million, first of all, the 18 million, is it material to the financial statement? So you find that figure too. So yes. The 18 million, that'll be 18 over 450 by 100. What will you get?
That's 4%.
That's 4%. So it means that the 18 million is material to the financial statement. First of all, according to IAS 37, they are not even supposed to recognize a contingent asset as well as a deferred income in the financial statement, because the event relates to a non-adjusting event. Even though it is certain, it is virtual that they will receive this amount from the insurance policy. First of all, the insurance company to come and do the assessment before they pay them this amount. So them recognizing it in the financial statement is not in line with IAS 37. So the amount should be what? De-recognized. So the financial statement should be adjusted to reflect, to de-recognize the contingent assets of 18 million and what? And the deferred income of 18 million from the financial statement. I think that is okay.
Beautiful.
All right.
Yeah.
So they have to adjust the financial statement. So what are the procedures the auditors will perform, like the evidence you expect to gather in respect of the event.
So one of the audit evidence is that the auditor should obtain a written representation from management.
Okay.
2, the auditor should obtain a fire report from the appropriate authority.
Okay.
And the auditor should also obtain the insurance policy for inspection.
Okay.
Yeah.
And the auditor should also do what again? So let somebody add up. Don't let me not even say anything.
It's finished.
What is finished?
The evidence.
Let me see something is the chat box, the chat box. Let me see.
He's just laughing at me.
My boss, is that what?
Zadok is only laughing.
No, but it's
Don't you also have a district management?
You have for discussion with management.
Yes, about what has happened.
Or what has happened.
On the yeah.
All right. And you should discuss with them and see whether if they are ready to amend adjust the financial statement. So what if management? Okay, let me not talk. I think that will be the next question. Okay. So let's move on. B part. Let's go on. So Auntie Doris, read the B for us. Let's move on.
So the B. Assurance has recently received correspondence from their insurance company informing them that the insurance claim had been rejected as the insurance policy had expired and not been renewed at all at the date that the disaster occurred. The going concern status is not considered to be affected and has sufficient assets to acquire a new head office and continue trading. The directors have refused to remove the contingent assets required. Discuss the implication of the matter described above on the auditor's report, recommending any further actions which should be taken by the auditor. 5 months.
You say, what is why?
you people, you are not paying insurance and you went ahead to recognize. You went ahead to recognize contingent assets. Now the thing has bounced and you not remove that thing. This is
if you understand the thing, it's very interesting. It's very funny. Your insurance policy, you are not paying premium. The thing has expired. Then you went ahead and recognized contingent asset. And they say they will not pay you. Even remove that thing you say no.
Takashi directors.
So you have to discuss the implication of the matter described above on the auditor's report and recommend any further actions which should be taken by the auditor. So what will be the implication on the auditor's report?
Okay, already we have determined the materiality of those issues, and we concluded that they are material. Am I?
Forget about materiality here. We are talking about B. Now we know the issue already. So the final decision there was that the contingent assets and the deferred income should not be recognized. So management have to adjust the financial statement to remove the contingent assets of 18 million, which is material to the financial statement, and the deferred income. They should remove them. Now the B part.
What is hold on. They said no. They are saying that the directors refuse to remove the thing.
Yes.
And so that will affect my opinion. That will be included.
That's what they say you should write.
That is why I'm saying that already we have established that that contingent asset is material. So it will inform the type of opinion that I will issue.
Okay, don't worry. I jump into your thing. So sorry for that. You conclude. Sorry for that. It's not a fight. It's It's not a fight. You say what? You
Let somebody continue. Let me rest. Let me take water and come back.
Hello, sir. So,
yeah, Auntie Jennifer.
and so, sir, I want to say that since the directors have refused to remove the contingent assets, it means the auditor's report needs to be modified.
Okay.
So,
to be modified.
and we have, I'm continuing from where I rather left. So since we know that the issues are material, we have to check whether they are pervasive or not.
Okay.
So that it's based on that, I will know the decision we'll make.
So what decision will you make? What decision will you make?
To me, I think it's material but not pervasive.
So what should be the opinion?
So I'll give a qualified opinion.
You give a qualified opinion?
Yes.
Only that?
Since it's material and not pervasive. And I'll check regarding the scope. This one is in terms of materiality. But checking the limitation of scope where you don't have the information on the insurance policy and others. That one too, I'll give a
no. Let me help you. Don't add that one, please. Don't add that one.
Okay, sir.
Don't add that one. So the first one you have said, just that. So what the opinion will be qualified opinion,
except for. So to add on to what my sister said, recommending any further actions, which should be taken by the auditor. So because this does not affect or cast significant doubt to the going concern status, the auditor should obtain sufficient and appropriate evidence in the claim of the insurance company, because they are now claiming that the insurance has expired. So the auditor needs to obtain appropriate evidence in the claim of the insurance company. And if the claim from the insurance company is true, then the auditors would have to discuss with management the implication of not reversing the deferred income against asset. And if management refuses, the auditor should now issue the qualified opinion and also engage those charged with governance. Okay. And if those charged with governance also refuses, then the auditor should request to speak the annual general meeting.
All right, thank you very much. So you see, that's one thing that the last part you add. I'm very happy for you. At this case, we were not told the date that the insurance company refuses the claim. So what you add is that if the audit report is already given to management, if the report has already be issued, but did the question say anything like that in the sentence? They say no. Assurance has recently received correspondence from them, so they were not giving the date. So you add up that if, let's say, the auditor has already issued the audit report to management, you should see ask management to what? Discuss with management the additional procedures, discuss with management to know what is their stand. They must amend the financial statement. If they refuse to do that because the report is already issued, you tell management not to give out the report to the general public because the reports have not yet been discussed at the AGM, at the annual general meeting. But if management still refuse that, they will not issue the thing, then you go ahead and tell them that, okay, they should not give out the report to the general public. And that one too, you include it in the issues that you communicate to those charged with governance. And subsequently, you request to speak at the AGM, at the annual general meeting. You will talk to the directors yourself that this is the issue, and management is refusing to amend the financial statement. So those are the further actions that the auditor will take. This one, they're asking you further actions. So kindly take note. Let's move on to the C part. Auntie Agnes, let's go. Hey, Auntie Aggie. Auntie Doris.
C. It is 1st July 2005. You are responsible for the audit of Baskin Co., a large listed package delivery company. The audit of the financial statement for the year ended 31st March 2005 is nearly complete, and you are reviewing the audit working papers. The financial statement recognized revenue of 56,360 million, and then in 2004 it was 56,245, representing a reduction. Profit for the year of 2,250 million, and in 2004 it was 2,630 million. Then a total asset of 37,554 million, and then in 2004 it was 38,765 million. The uncorrected misstatement identified during the audit of Baskin Co. are described below. During the year, Baskin Co. reduced the value of their provision for customer refunds, which is recognized in the financial statement. For the past 5 years, the value of the provision had been calculated based on 7% of 1 month's sales, using an average monthly sales value. Should I continue?
Yes, let's move on.
Management argued that due to improved internal processing systems, such a high rate of provision was no longer necessary and reduced it to 4%. Audit procedures found that refund levels were similar to previous years, and there was insufficient evidence at this early stage to confirm whether the new system was more effective or not. The audit engagement partner is holding a meeting with management team of Baskin Co. next week, at which the uncorrected misstatement will be discussed. Required: explain the matters which should be discussed with management in relation to each of the uncorrected misstatement, and assuming that management does not adjust the misstatement identified, evaluate the effect of each on the audit opinion.
Okay, thank you very much, our sister. Thank you very much. So this question, I don't even want to talk plenty. Yeah, let somebody digest the question for us. Let's move on. So the first requirement, you have to explain matters which should be discussed with management, because we were told that the audit engagement partner is holding a meeting with management of Baskin Co. next week. So you have to explain the matters. Explain the matters which you should be discussed with management relating to each of the uncorrected misstatements. And assuming management does not adjust the misstatement, you should evaluate the effect on the auditor's opinion. So first of all, I've been saying it, you must identify the issue before you can be able to discuss it. If you don't identify the issue, how will you discuss it? So in case of Baskin Co., what is the issue? What is the issue? What is the main issue there?
Changes in estimates.
Changes in what?
Estimates.
Changes in estimate. So this question, the examiner is testing what? IAS what?
8.
They are changing their what? They say what? During the year, Baskin Co. reduced the value of their provision for customer refund, which is recognized in the financial statement. Now, for the past 5 years, the value of the provision has been calculated based on what? 7% of 1 month's sales. So the estimates they are using to calculate their provisions for the refund to their customers is 7% of 1 month's sales, using an average monthly sales value. Now, they are arguing that due to improved internal processing system, the rate of 7% is very high and it will no longer be appropriate, that the rate should be reduced to what? To 4%. Now, they are arguing because of the improved internal control system, the internal processing system, the high rate of 7% is no longer necessary. So the rate should be reduced from 7% to 4%. Now, in your audit, you identified that what? Audit procedures found that refund levels were similar to previous years. Take note. Refund level. So the risk level, the risk at which management made their refund, the level is similar to previous years. The years on which they have been using the 7%, the audit for the year ended 20S5, you still the procedure still dictates that what the refund level is still similar to previous years, and there was insufficient evidence. So as at this period, the auditors don't have appropriate and sufficient evidence at this stage to confirm whether the new system was more effective or not. So the new system they are using, the new improved internal control system they are using, the auditors at this stage, because they just introduced the new system. So the auditors, you cannot determine that this early stage, the new system will be more effective. So now, what are the matters that you discuss with management in relation to the uncorrected misstatement? What are the matters you discuss with management? Let's go.
I think in addition to the IAS8 that my brother mentioned,
yes,
I can also see provision for warranty, which is under the 37.
Yes, which is under 37.
Yes.
Yeah, provision for warranty because they are making refunds to customers. So that is our 37 yes. Also talks. Yes. IAS 37 provisions. Yes. So what are the matters you consider?
Okay, so first we'll determine the materiality of the provision, the change in the provision to the warranties that are likely to come.
Okay.
Or the refunds that are likely to come.
Okay. So you start. So first of all, the provisions, the 7% on 1 month says, how much would that be? So you do that calculation first. So the provision that they have been recognized previously, then you compare it with the new provisions that they are about to recognize. I see the difference. So the provisions, when you calculate it, you comment on it. Is it material to the financial statement or not? The reduction in the provision, is it also a material to the financial statement or not? So let's do that calculation. Let me do that calculation here. So the first one, 7% of 1 month sales. How will you do that calculation? How will you do that calculation? So first you must find the 1 month sales. Is that not it?
Yeah.
So we are using revenue. Is that not the case?
Yeah.
So what's revenue for 20S5?
56,360.
56,360. So Revenue for 20S5 is 56. What is the figure?
That's it. 360.
0. So you find 1 month divided by what?
12.
By 12. Then you multiply it by what?
7%.
0.07. What will you get?
You will get 328.
328 Ghana cedis. Point what?
0.77.
Okay, 0.77 million. So it means this is the provision they were recognizing first in the financial statement. Now, the change, reducing it to 4% now. So the 4% will not be what? So that will be, the 4% will not be what? So that will be 56, 360 divided by what? By 12, multiplied by 0.04. Is that not it? That will give you what?
187.87.
187.87 million. So if you are now reducing the provision, so what's the difference? The difference will be what? The difference will be what?
$140.9.
140 point what?
9.
9 million. You see, so this one you are now reducing the provision from 328.77 million to what? 187.87 million. So the difference is 140. This 140 is immaterial to the financial statement. The 140 is immaterial to the financial statement. Because it will now what? It means your profit will now increase. Is that not it? Because you are reducing the provision, your profit will now increase. So the increment. So that will be 140 over what the revenue is what? 56, 360 by 100. What will you get?
$0.25.
Get 0.25%. So it means that when the reduction is immaterial to the stated profit.
So it's immaterial.
It's immaterial. Are we using the right figures?
Yes.
Okay, so it's immaterial to the stated profit. But while you are reducing the provisions by 140 million, it must be what? Accompanied with sufficient evidence. It must be accompanied with sufficient evidence. So look at it. They are saying that the audit procedures performed were what? That the risk level is still similar to that of previous years. So when you are reducing your provisions by 140 million, which is all, even though it is immaterial to the financial statement, still it must accompany
nature of it. Yeah.
Even though the nature of it is immaterial to the financial statement, still it must be accompanied by what? Sufficient evidence. But if you look at it, the risk is still similar to previous year. So it means that reducing the provisions from 7% to 4% is not even necessary at the first place because the risk level is still similar. You see, so because management, they are basing their reduction on the on the improved internal control system that they have identified. At the early stage, the auditors cannot confirm that the new system will be will be more effective. So in that case, the financial statement must be adjusted. The provision recognized must still be based on the old one. So the management must adjust the financial statement. So that's the issue you are going to discuss with them, with management, that even though they are reducing the provision by 140, yes.
Yes, please. So please, I think you mentioned profit.
I mentioned profit. I use revenue. Were you giving profit in the question?
Yes.
What is the profit?
Yeah, so if you are using profit, then we'll get a different.
2550.
It's profit that we have to use. It's profit because it will increase the profit. That's why I asked whether if we are using the right figures.
Even if you use profit, it will be immaterial.
what percentage will you get?
5.5%.
5.5% is material.
It's
So,
material.
but no, but is the threshold not from 5% to 10%?
For profits?
Yeah, profit before tax.
Yes, and the answer is 5.5.
The answer is 5.5. So how much is the
Yes.
profit? Profit.
The materiality threshold is 5% to 10%.
Yeah,
for
it's
profit.
5% to 10%.
Exactly.
Yes. If it is within, if it is between its material. Not that it should be more than 10% to.
It is within. So
yeah, it means it's material. But if it is below, then it is not material.
Oh, okay.
Yeah, if it is below 5%, then it is not material. But if it is within 5.5 to 10%, then it is material, or even more, then it is material.
Okay.
Okay. So how much is profit? That's the reason I asked whether if you're using the right
5.5%.
So the profit by amount, profit for the year is what?
2550.
2550. So times 100. That will give you 5.5%. It's material to the profit. Because when you reduce your provisions from 328.77 to 187.77, the difference is 140. It means you are increasing your profit. And when you increase the profit, the percentage is 5.5. It is material to the stated profit. So they must go adjust the financial statement to reflect the old provisions. So that's what you are going to communicate to the management. Now, if management does not adjust the misstatement, what will be the effect on your opinion? But the reduction, is it material to the total assets?
Hello, sir.
Yes.
Please, can the materiality also be checked from the angle of finding the difference between the 7% and the 4% so that you get 3%, and you also check to the materiality level of asset and find out if it is material or not material? I mean, that angle, would that also hold?
So you just check the reduction like that? No, that one will not work. I think your approach, let's see whether if it will be applicable. Let's do some tests and see. When you, let's say you have from 7 to 4, that will be 3%. Is that not it? So
yes, 7 to 4, the reduction is 3. The difference is 3.
No, if you are taking the percentage as a whole like this, materiality doesn't work like this. This one is the whole percentage. It must be applied on a certain figure.
Oh, okay.
The whole percentage like this cannot work. No, it cannot work. It will mislead you. It will mislead you. It will mislead you.
Okay.
Yeah, it will mislead you.
Okay, thank you.
It will mislead you. All right. So the fact of the matter, we have established that the reduction in the provision is material, which will increase the stated profit. And the increment of the 140.9 million is material to the stated profit.
Hello there.
Yes, I
think the difference of 140 was work on the revenue instead of the profit. Because the 563.
Yeah, the provision made was based on revenue. So I think what we did is in line. You see, the question, they are saying that the 7% here, the 7% here is on 1 month what? It's on 1 month sales. So that is revenue.
Okay.
Yeah, that is revenue, yes.
Okay, sir.
But the point I'm making is that when you reduce the provision from 328.77 to 187.87, the difference is 140.9. Now, this 140, if you are reducing the provision, what the treatment of the provision? How do you treat the provision?
You debit P&L and you credit your current liability.
Debit profit or loss, then you credit what?
credit your liability account.
Your liability account, you see. So if you are debiting P&L, it means that you are reducing what? Profit. Is that not it?
Yeah.
You are reducing profit. You see. So now the new provision is now 180. So it means that profit will be increased by what? By 140.9 million. Is that not it? So this increment, you are saying that is material to the stated profit. The stated profit is 2,550,000 Ghana cedis. So it means that the reduction that they have done, it must be accompanied with sufficient and appropriate audit evidence. By the evidence, the risk level, the audit procedures determine that the risk level is still similar to the previous years. So management assumption of reducing the provision from 7% to 4% is not in place. So they must adjust the financial statement to reflect the old provision. Now, that's how you are going to communicate to them. Now, the second requirement is that management, you assume that they refuse to adjust the financial statement. What will be the effect on your audit report? What will be the effect on the audit report?
It will be qualified except for.
So the opinion will be what? Qualified except for. Based on the reason that the issue is what?
Material.
It's material, but
material.
not pervasive.
It's material, but not pervasive. So issue qualified except for. Okay, all right. I think we are together. Question 9, let's move on. At least I want us to do 10 questions today. Any question? If you have any question, you can ask. But Sister Doris, let's move on to question 9. Is Sister Doris on the line? Okay, Auntie Agnes, I'm sure you are on the line now. So it's like Sister Doris is not on the call. So kindly read the question for us. Auntie Agnes, if you can hear me.
Okay, please. Question 9A. You are the partner responsible for performing an engagement quality control review on the audit of Pluto PLC, a listed company. You are currently reviewing the engagement partner's proposed auditor's report on the financial statement of Pluto PLC for the year ended 31st March 2009. During the year, the company has undergone significant reorganization involving the discontinuance of 2 major business segments. Extracts of the proposed auditor's report are shown below. Basis of adverse opinion. The directors have not recognized a provision in relation to redundancy costs associated with reorganization during the year. The reason is that they do not feel that a reliable estimate of the amounts can be made. And so the recognition criteria of IAS 37 have not been met. We disagree with the directors as we feel that an estimate can be made. This matter is more fully explained in a note to the financial statement. We feel that this is a material misstatement as the profit for the year is overstated. In our opinion, the financial statements do not give a true and fair view of the financial position of the company as at 31st March 2009 and of its financial performance and its cash flows for the year, then ended in accordance with international financial reporting standards as adopted by the European Union. emphasis of matter, earnings per share. The directors have decided not to disclose the earnings per share for 2009, as they feel that the figure is materially distorted by significant discontinued operations in the year. Our opinion is not qualified in respect of this matter. Required, critically appraise the proposed auditor's report of Pluto PLC for the year ended 31st March 2009.
All right, thank you very much. Thank you very much. Very interesting question. Very interesting question. Okay. So let's digest the question and see the proposed auditor's report, if it is in line with the applicable standards. So from the question, we have established that the financial year... Senior Justice.
Sorry, sir.
Don't worry, you can make the comment. We are interested. Thank you very much. So the financial year ends for Pluto PLC is 31 March 20S9. All right. So the main issue here is that during the financial year, the Pluto PLC has undergone significant reorganization involving the discontinuance of two major business segments. Which standards talk about discontinued operation?
IFRS 5.
Okay, so the examiner is testing IFRS 5 here. Non-current asset held for sale and discontinued operation. The examiner is testing that standard here. Now, let's move on. So this is the extract from their report. So they issue what? Adverse opinion. The opinion issue is adverse opinion. But in this case, what is the appropriate way of what? Of stating the, or in writing the audit report? Should the basis for opinion paragraph come first?
Oh, no.
So which one comes before?
The auditor's opinion.
Or come first. All right. So they are even doing what? They see in the second paragraph, in our opinion. So it means that they have combined two paragraphs together. Is that not the case?
Yeah.
They've combined opinion paragraph and basis for opinion paragraph, which is not appropriate. These are the things to be writing. I'm telling you. They say the requirement is critically appraise the proposed auditor's report of Pluto PLC for the year ended. So these are the things we will be writing. These are the simple ones which will fetch you some mark for you to get your 50 marks and move forward. So the structure of the report cry is not even in place. No, it's not even in place. They have combined two paragraphs together. The opinion paragraph and basis for opinion paragraph. So in their basis for opinion paragraph, they are saying that they've issued adverse opinion. So the reason for issuing the adverse opinion to them is that the directors have not recognized a provision. So IAS what? 37. In relation to redundancy costs associated with the reorganization during the year. So the reason is that they do not feel that a reliable estimate of the amount can be made. And so the recognition criteria for IAS 37 have not been met. That is their stand. They think, the directors think that they don't feel that the amount for the redundancy cost can be reliably measured or estimated. Because of that, the requirement, the criteria for IAS 37 have not been met. So in that case, they did not recognize any provision in their statements of financial position and the statements of profit or loss. Now, auditors are saying that we disagree with the directors as we feel that an estimate can be made. This matter is more fully explained in the note to the financial statement. We feel that this is a material misstatement as a profit for the year is overstated. So in our opinion, the financial statement do not give a true and fair view of the financial position of the company as at the financial year ends, and of its financial performance and its cash flow for the year. That's the first paragraph. Now, the second one, they are saying that they issue an emphasis of the matter paragraph. And what they brought under the emphasis of the matter paragraph is earnings per share. And they are saying that the directors have decided not to disclose the earnings per share for 20S9, as they feel that the figure is materially distorted by significant discontinued operation in a year. So our opinion is not modified in that respect. Now, appraise this auditor's report for me. So I want somebody to appraise this auditor's report for me.
I see two things.
All right.
Now, first one is on the emphasis of matter. The emphasis of matter is when the issue is disclosed, but the auditor wanted maybe to do more clarification on it. So with the earnings per share, they are saying that it is not disclosed in the statement. So the heading shouldn't be emphasis of matter. It should rather be maybe other matters paragraph. That is number one. Can I continue?
Yeah, continue.
Okay. Number two, I've seen something somewhere. Give me a minute, Reka.
Somebody will bail you, eh?
No problem. The person can continue. I will still find it and come back.
Yeah, look for it and come.
I think the second one is that the auditors are too harsh on management because of the statement that they have issued, the adverse opinion that they have issued. Because they've stated that the issue is only material, it's not pervasive, and the opinion that they have to issue, it should be a qualified opinion except for not an adverse opinion. So those are the two issues that I've identified.
Thank you very much. Thank you very much. Thank you very, very much. All the two issues are in place. But why do you see the issue is not pervasive? Me, I can't see it too.
They say we feel that this is a material misstatement. If it were to be pervasive, they would have stated it.
Yes. So first of all, the opinion they have even stated is not even in place. You are right. So the opinion should be qualified opinion except for exactly. Then you talk about the paragraphing, combining the two paragraphs together. Combining opinion paragraph and basis for opinion paragraph. We talk about it. We talk about the adverse opinion that they have issued. The issue is supposed not to be an adverse opinion. It should be qualified opinion except for. The emphasis of the matter paragraph, the issue must be disclosed in the financial statement. That users want to draw the attention, the auditor want to draw the user's attention to. But in this case, they said the directors have decided not to disclose the earnings per share. So this one should not even come under emphasis of the matter paragraph. It should not even come under emphasis of the matter paragraph. So this Pluto company, is it a listed company? Pluto company, is it a listed entity? Yes. We are told that Pluto PLC, you see, these are the things you should be paying attention to. Pluto PLC is a listed company. It's a listed company. So if it's a listed company, what paragraph should you bring
your key audit matters?
Key audit matters. Thank you very much. Key audit matters. You see, so this one, if you didn't go back to know that they are a listed company, you will have said it should come under other matter paragraph. Is that not it?
Yeah, that is what I even said, bro.
Which is wrong because they are a listed entity, so it must come under key audit matters. Key audit matters. Key audit matters. Somebody want to ask something, then we move forward. Mr. Nathaniel, you want to finalize the deal for us? Okay, you finalize this for us so that we move forward.
Oh, it's been finalized already.
Are you sure?
Oh, it's because there is this issue here. I don't know. I say, in our opinion, financial statement do not give a true and fair view of the financial position of the company as the first March and of its financial performance and its cash flow for the year ended in accordance with international financial reporting standard adopted by the European Union. I don't know if that as adopted by the European Union.
Okay, this please. Oh, it's just they're just talking about the standards.
Just giving. Okay.
Yeah, they're just talking about the standard. You see, the auditor's opinion, the auditors have, I don't know which kind of, which auditors is this? Which firm is this? I've just stated the firm.
There should be one local small firm.
There should be one local firm of started accountants.
Recent brain and Cephas.
You say what? Come again. Let's go to the next question. Let's go to the next question. The B part. Okay. The B part. Me, I'm a bit tired. Are we not tired?
I think the B will do for the day.
The B will do for the day. Okay. Actually, today we have done a lot. We have done a lot. So, Auntie Agnes, read the B. Let's digest the B. We will end it here. We will meet on Saturday and finalize the whole deal. This thing we are doing here, you cannot go and write the exam and you will not get your 15 mark. I don't know. If you don't get your 15 mark there, Charlie, I'll be surprised though. Auntie Agnes, read the B part for us.
Okay, please. B. You are an audit manager in Sigmund and Associates, working on the audits of the Assurance Group. The group, whose financial year end on 31st March 2015. This is the first time you have worked on the group audits. The draft consolidated financial statements recognize profit before tax of 6 million Ghana cedis, and that of 2014 is 9 million Ghana cedis, and total assets of 90 million Ghana cedis, and that of 2014 is 82 million Ghana cedis. The group manufactures equipment used in oil extraction industry. Goodwill of 10 million Ghana cedis is recognized in the group statement of financial position, having arisen on several business combinations over the last few years. An impairment review was conducted in March 2015 by Abednego Ejay, the group finance director. And this year, an impairment of 50,000 Ghana cedis is to be recognized in respect of the goodwill. Abednego has prepared a file of documentation to support the results of the impairment review, including notes on the assumptions used, his calculations and conclusions. When he gave you this file, Abednego made the following comments. I don't think you should need any evidence other than that I don't think you should need any evidence other than that contained in my file. The assumption used.
Why is he too proud? Why is he too proud of himself? Who is he?
I mean, you know the things,
Okay,
let
him do mistake right now and let's see what I'll do with the way I'll deal with him. Auntie Agnes, let's go. That was just by the way.
Okay. So you shouldn't need to look into them in detail. The assumptions are consistent with how we conducted impairment reviews in previous, and your firm has always agreed with assumptions used. So you can check that back to last year's audit file. All of the calculations have been checked by the head of the company, by the head of the group's internal audit department. Abednego has also informed you that 2 members of the sales team are suspected of paying bribes in order to secure lucrative customer contracts. The internal audit team were alerted to this when they were auditing cash payments and found significant payments to several new customers being made prior to contracts being signed. Abednego had asked if Sigmund and associates would perform a forensic investigation into the alleged bribery payments required. Discussed how professional skepticism made by Abednego, explained the principal audit procedures to be performed on the impairment of goodwill. Recommend the procedures to be used in performing a forensic investigation on the alleged bribery payments.
It is question or part of the more question?
Yes.
It's part of the more question, eh?
And this is not the only one. There are other ones that we look at. They were
part of the more questions. It's like the forensic investigation I saw here. I say, it's part of the more question. It's part of the more question. Okay. So the first requirement is to explain how professional skepticism should be used to apply to the statement made by Abednego. I'm tired. Somebody should help me digest the question so that we see how best we can answer. We can apply professional skepticism to the statement made by these 2 known. Is it the finance director or what? The Abednego one?
The group finance director.
No wonder the man is too known.
He's a big man.
He's a big man. He's a big man.
A big man.
Group finance director is a big man. Okay, let's move on. Okay, so let's look at the statement that he made. So in the question, their profits, their financial year ends on, the assurance group financial year ends on 31 March 2015. Okay, and this is the first time you have worked on the group audit. It means that the auditors, they don't even have the experience in group auditing. Is that the case?
Yeah.
This is their first time they are auditing a group. They are auditing a consolidated financial statement. So the profits before tax is 6 million for 2015. 2014, it was 9 million. There was a reduction of 3 million there. Total assets for 2015 is 90 million. That of 2014 was 82 million. So the asset has increased. So the group manufactures equipment used in the oil extraction industry. So there was a goodwill of 10 million. Goodwill of 10 million was recognized in the group statement of financial position, having arisen on several business combinations over the last few years. An impairment review was conducted in March 2015. That's the end of the financial year. Abednego conducted an impairment review. And this year, an impairment of 50 million or 50,000. 50,000 is to be recognized in respect of the goodwill. So there was an impairment review conducted by the group finance director, and he noticed that the goodwill has impaired by 50,000 Ghana cedis. Abednego has prepared a file of documentation to support the results of the impairment review, including notes on the assumptions used, his calculations, and his conclusions. Then he gave you the auditor the file, and he made the following comment. So this is the comment that we are asked how we are going to apply professional skepticism in handling the comments made by Mr. Abednego. So he is saying that he don't think that you should need any evidence other than the one that he have in his file. Why isn't dictating for you on what to do? It will allow you to do your work. So he's saying that the assumptions used are straightforward. So you shouldn't need to look into them into detail. Who told you? Why shouldn't we look into them into detail? So the assumptions are consistent with how we conducted impairment reviews in previous years. And your firm has always agreed with the assumptions used. So if you like, you can check that back to the last year's audit file. Okay, the man is too confident. All right, all of the calculations have been checked by the head of the group internal audit department. No problem. He's also making another claim. He has informed you that two members of the sales team are suspected of paying bribes. Okay, in order to secure lucrative customer contracts. So the internal audit team were alerted to this when they were conducting cash payment, auditing on cash payment, and found significant payment to several new customers being made prior to the contract being signed. So he's asking whether if your audit firm will perform a forensic investigation into the alleged bribery payment. So you are to discuss how professional skepticism will be applied to the statement made by Mr. Abednego. How are you going to apply it, the professional skepticism to the statement that he made?
Okay, so in this case, we will talk about what professional skepticism is about.
Okay.
And
what is it about? What is it about?
Yeah, so it's having a question mind as the auditor.
Okay.
That relates to fraud or error and material misstatement. And also, the auditor should also be alert on some issues relating to the financial statement. And the third point is that the auditor should critically evaluate the evidence obtained.
Okay.
So in this case, what the group finance director is stating or is urging to the fact that he's done with the impairment review and all of that. What the auditor needs to do is to critically evaluate that evidence and do substantive testing, test of details.
Okay.
Because the audit evidence is more reliable when the auditor himself conduct or obtain the sufficient and appropriate how do you put it?
Audit evidence.
More reliable, yeah. So it's more reliable when the auditor gets the evidence himself as compared to group finance director. So in that case, the auditor should do more of analytical procedure, test of details, make sure that whatever the group finance director is claiming, there is sufficient and appropriate evidence to back that.
Okay, thank you very much. Now,
that's the first point.
Okay, the second point.
No, I mean, that's my view on the, is it the I?
Yeah, the I.
So the I, yeah.
Okay. Okay. Who else is adding? You see, the profit for the year has fallen. The profit for the year 2015 is 6 million. That of 2014 is 9 million. So the profit has fallen by what, 3 million. What percentage is that? 3/9 by 100. What percentage is that?
33.
33%.
See, the profit has fallen by what? By 33.3%. That should tell you that the impairment cry it has lasted long overdue, or maybe the impairment has what? Has been understated. Because the profit has fallen. 2014, you have 9 million profit. 2015, you are now having 6 million. What will cause the reduction in the profit? So it means that the impairment that the group finance director say they have conducted, and the impairment is only what? Is
50,000.
50,000. It means that the impairment has what? Has been understated. Huh? So the man
So it is likely to be more than that.
It's likely what?
To be more than the
It's
50,000.
likely to be more than the 50 this thing. It's that the man is doing to know. It's likely to be more than that. So the auditor you must apply what? A professional skepticism in handling the impairment. You see, in handling the impairment. So the auditor, you must determine, you must even that evidence he say he give you, you might even throw it away. Like what I'm gonna say. I was the Nathaniel said, you must perform your own analytical procedures, conduct your impairment review, and determine the appropriate value of the impairment. So you must exercise the professional skepticism on that matter, because it's like he's trying to dictate the audit work to the audit firm, that I don't think you should need any evidence other than that contained in my file. That man, you should even be suspecting him. What do you guys think?
It be IGP.
The man should be suspected. It's like we should be suspecting the man. Why would he be saying that? I don't think you should need any other evidence other than the one contained in my file. No, you allow the auditor to perform their own procedures and get their own evidence.
Saying those things will rather increase my skepticism.
Exactly. So it should tell you that no, even the reduction in the profit alone should even tell you that no, something is happening. The employment review, the man say he has conducted the talking plenty, that your audit firm has always agreed with it. Allow me, the new auditor, even though this is my first time. You see, the man realized that who is the audit senior manager? They just say you. Okay. They didn't mention anybody. And they say that this is the first time you have worked on a group audit. So the man realized that this is the first time the senior manager is working on the group audit. So he's trying to intimidate the man, trying to dictate to the man what to do. So the senior manager must apply professional skepticism to what this man is saying. So he must conduct different impairment review and determine what the impairment loss and subject it to what it may be subject to management bias. So you should question the finance director of the consistency that he's talking about. If that is the case, why should it be the reduction in the profit? So the evidence that he has provided it cannot be reliable. What he's saying that the evidence he has on his file, it cannot be reliable. The auditor must perform his own procedures to get his own audit evidence, and the assumptions used in the calculations must be checked. You should go back and check all the assumptions. Now, the second part, the audit procedure to perform regarding the impairment. So the impairment, what are the audit procedures you have to perform regarding the impairment? They say 5. So they say there is 5 marks. So we must at least state at least 5 audit procedures. 5 audit procedures regarding the impairment.
In no particular order, you have to determine the current.
You have to determine
the current value of the asset.
Okay.
And also
determine the current value of each asset.
The asset that is impaired or that is subjected to impairment.
It's goodwill. It's goodwill. There is impairment in relating to goodwill.
So goodwill, yeah, sure.
Yeah, it's relating to goodwill.
Yeah, sure. So goodwill.
Yes. So the assumptions used by the auditor, they must review all the assumptions used in preparing what in conducting the impairment. You review all of them. Then you make sure that, you see, they say the business, there's something I saw somewhere. They say, they say the goodwill is recognized in the group statement of financial position.
Okay.
Having arising on several business combinations. Several business over the last few years. So you must review the goodwill, go back and review the goodwill calculation on all the business combinations that they have done. It will be the case that the finance director is hiding something. It's hiding something. But the goodwill is of 10 million. It's recognized from several business combinations. So you have to go back and review the goodwill relating to all the business combinations. Then what again will you do? At least 5.
So we have to gather more evidence in relation to the documents that are provided.
Oh yes, the more evidence that you have to gather them. You have to gather the more evidence. You have to recalculate, you reperform, you reperform. You have to recalculate all the calculations that they have done. Then you check the arithmetical accuracy of all the calculations. You reperformance, you do all the calculations yourself relating to the goodwill. You check the arithmetical accuracy of all the performance that they have calculated. Okay, the last one on the bribing allegations. You have to recommend procedures to be used in performing a forensic investigation on the alleged bribery payment. So I think that's the last paragraph. So what are the procedures you are going to recommend? Yeah, who is talking?
So, hello.
Yeah, I can hear you, Senior.
Okay, so can we say that because if the group financial director is the one telling you that, or not you, but the auditor, that 2 members of the sales team are suspected of paying bribes in order to secure lucrative customer contracts. Now, the issue is that who is paying that bribe? Is it the company that is paying? And if the company is the one paying, who is approving? Who is giving authorization? Is it the same group financial director who would give the authorization? It's not the one telling you that. So there could be that the internal controls are not operating effectively.
Okay.
So in this case, in performing the forensic investigation, the auditor should, 1, use enhanced substantive procedure.
Okay.
That's 1. But before that, there should be an objective for the investigation. Because normally, if an auditor is to conduct a forensic investigation, there should be established an objective. So the objective should be that the alleged paying of bribes.
Paying of bribes, yes, by suspected members of the sales team, yes.
Yes. And then carry out the audit procedure in line.
So you should, first of all, the auditor have to interview those 2 suspects.
Yes.
You have to interview them. I know who they are paying the cash to. They say they pay cash to some people, so you have to interview them.
Who is the one paying? Is it the company that is paying, or they themselves are using their own money to pay?
Yes. So you interview them because they are telling you the man is telling you that they pay bribe in order to secure a lucrative customer contract. So you interview them regarding the nature of the payment they are making, and the contract. Then you have to review that contract.
But wait to see. I want to find out. So if the sales team are paying this right for sales growth to increase the company, and maybe because their profit have also decreased, who's the one paying the bribe? Because I don't see, I'm not getting the logic from the group financial director. Is it complaining that the company is paying bribe?
No.
Our profit is going down. Or
you see,
or the payment is coming from the pockets of the members, and still profit is going down, and he's not happy. Where is this standing?
The payment is not coming from the members, or it's coming from the company, because when you read the second line, it said that in the internal audit team were alerted to this when they were auditing cash payments.
Exactly.
And found significant payment to several new customers being made prior to contract being signed. So the money were paid from the coffers of the company.
Yeah. So the group finance director.
But as at this stage, how can you justify that it's the company that is paying? If they is paying for the company's confess, then the group finance director, he will be the one paying.
Yes.
And so he should be part of the forensic.
He should be the first person that will be put to investigation.
Yeah.
But he is telling you, he is the one telling you that
it's just a cover up. It's just a cover up that he's doing.
He is the one telling you that 2 members of the team are.
He's a bad man.
So you see, so while you perform your forensic audit, everything will come clear. You see, so while you interview those 2 suspects, they will tell you. So what you guys are saying is that those people that will tell you that they are not the one paying. The thing is the company that is paying. So you don't know. So you are just going to do your forensic investigation. Then you come out with the truth. So you interview
the issue about what the internal audit people have found out, it is still the Abednego, the finance director, who is saying it.
He is telling you that the audit manager all these things. You don't know. He is the one telling you.
So even this one, I don't need those 2 people before I will know that the payment is made from
the payment. The internal audit also confirmed that the payments were made, but they are the main suspects. So they are the first people you have to interview. When you interview them, they will tell you the whole story. So you interview them about the nature of the payment, and the contracts that have been signed. They will tell you if it is their own money they are paying. They will tell you, even though the internal audit team have determined that several payments were made to new customers before a contract is being signed. Are you going to rely on the internal auditor's work?
Oh, well, I can still review their work too.
You will definitely review. So in reviewing it, you have to start from the 2 suspects.
Okay.
Because you cannot start from the man himself. You cannot start from the Abednego man himself. If you start from him, he will still be telling you the same thing. So you have to start from the suspect. Immediately you start from them, they will give you the whole story. They'll give you the whole story. So you interview them, then you have to do what? Identify all the new customers. That payment have been made to. Identify all of them. Then you review the terms of the contract. You read the terms of the contract and see that what is the term of the contract? Those new customers, what contract have they been paid for? I mean, by the time you finish doing these things, you know either if the people they are actually paying bribe, or if it is the company that is paying, or it's the 2 company that is paying. You can only come out with the conclusion after you have done with the procedures. So it may be kind of that the man is trying to hide the thing. He's even part of the team, but he's trying to hide it. But as at now, you cannot, unless you are done performing the procedures. So we are done with question 9. It's 9:12. So the suggestion is that we will end here. Then we will continue on on Sunday, 1 p.m. to 5 p.m. 1 p.m. to 5 p.m. I've sent some sample questions and suggested answers on the page. I hope you guys have it.
Today?
Oh, I think that was somewhere, not today. I think on Wednesday or Tuesday, yes.
Yeah.
Yes, you can't really go through them. There are some questions in them. I took my time to provide some suggested answers to the questions. So try and read through them. Try and read through them. Okay. So we end the class here and then we will meet on Sunday.
All right, thank you.
All right, thank you too.